Is going to be leaving after only 2 years at the Italian label. And so the French parent, of course, listed in Paris, will keep an eye on that one. They warned back in October about the annual profits that they would fall to the lowest level since 2016. So the sector very much already in focus, Guy.
Also a big day for the banks. Keep an eye on SocGen. That's going to be interesting to see how it trades. Lots of money coming back to shareholders. How does that all factor in? Let's find out. It's time for the opening trade. FTSE 100, as Critty was indicating, maybe a more positive start to the day. We're expecting it to shoot higher, up maybe 0.6%. So we're going to see some traction coming through there. We are factoring in a lot of fairly big companies reporting numbers today. So all of that needs to be digested before we get a true sense of where the kind of the top-down story is really going here. But remember, we're pre-payrolls. That's coming through tomorrow. That's going to be a factor. We're obviously watching what is happening in terms of the Bank of England today. There are macro factors that you want to throw into the mix. But there you go. FTSE 100, as anticipated, up by circa 0.7%. The IBEX is out of the gate up 0.4%. The Stock 600 is out of the gate up 0.4%. Waiting for the CAC on. You've got SocGen to trade there. You've got Caring to trade there. Two really big and important stocks to that market are about to open. The DAX is yet to open as well. Keep an eye on what is happening with Germany, as politics is another factor we need to throw into that market mix as well, Chrissy.
Certainly one that we're going to keep an eye on. Speaking of Germany, some of the kind of German story that we're seeing, at least in the early indications from the Stock 600 trades, is really where the leadership is this morning. I'm seeing a little bit of biotech, a little bit of technology really leading the pack this morning. But the downside is very much in the French market. Perhaps this was the underperformance we saw in the futures indication as well. With the likes of LVMH, for example, down about 0.4%. But it is one of your biggest weights on the index. I'm seeing some opening trades on Caring as well, down about 2%. So luxury, Anna, certainly not having a good day.
Yeah, I mean, that sector just facing a lot of uncertainty, isn't it? And it has been for such a long time. And then you add on top of that the personnel uncertainty on the creative side at Gucci, such a big part of the profitability over at Caring, then certainly that is going to cause some confusion. Yeah. So consumer products and services is weaker. As you say, Caring down 2%, LVMH down a little in sympathy, it would seem.
Astra's up quite nicely, 2.32%. That company out with numbers, big heavyweights on the London market. You've got a bit of a bounce back in UBS. It's up a little bit as well, up around 1.2. Novo's strong as well today. So Pharma, as we've already indicated, is high. Novartis is also seeing some strength as well. The car sector looks weak, though. Mercedes is down. Stellantis is trading a little bit lower as well. Vestas after
Volvo Cars in that sector is down by 7%. That's on the back of the numbers that they put forward and the descriptions of the year ahead looking pretty lackluster.
It's a relatively small business. It's pushing very strongly into the electrified side of things as well. But and those are two hard spaces to be in right now. So they were in some ways kind of insulated early on because Volvos are relatively high-end cars. Early adopters tend to buy high-end cars.
Yeah.
The real struggle for European car makers is actually kind of democratizing what is happening with EV, and that's proving to be much harder than anticipated.
Absolutely. We're still waiting for SocGen. We're still waiting for Maersk. We're still waiting for Ørsted. I should mention Carlsberg is having a pretty decent day. Shares higher by about 2% this morning, despite their 2025 profit coming a little bit lower than the street was expecting. So interesting that we are seeing such a rally in those shares. In the meantime, as we're, of course, waiting for the full indexes to open, we'll bring you the pricing as soon as we get them. Let's bring in Charles-Henri Monchot, CIO at Seas Group, joining us around the table. Good morning. Thank you so much for joining us. I mean, I feel like we're in the thick of earnings palooza at the moment. It's a sum of all parts trade. For you, what is the biggest upside? What's the biggest downside in this market?
Well, the downside, the negative headlines are all around. From one weekend, we heard about DeepSeek, then trade war. But then we need to also to look at the big picture. And the big picture is quite positive. You know, we have double-digit earnings growth in the U.S. Bond yields are coming down. You know, many were expected some kind of stress on that side, but liquidity is coming. We're probably going to get this liquidity bazooka in the U.S. because of debt ceiling being postponed, the increase of debt ceiling being postponed, you know, till this summer. So we're talking about $300 billion of possible liquidity boost in the U.S. That's twice the amount of tariffs that's, you know, the economy is facing. So all in all, when you have positive earnings growth, bond yields coming down, I'm sorry to say, but it's still positive for equity markets, despite all of these negative headlines.
You don't have to be sorry. That's
I think the bulls will be very happy that you said that. But let me challenge you there. Isn't that liquidity bazooka well telegraphed and well priced into this market?
Well, you know, I think, you know, looking at the 10-year, I think the 10-year is still a surprise for many because we're not seeing much weakness on the macro fronts, and the 10-year is coming down. So is it because the market is pricing in the fact that tariffs are bringing additional revenues, and that means lower treasury issuance? Is it because of the words from Mr. Bessent, who yesterday said that he's targeting the 10-year? Or is it starting to indeed you know, price in this bazooka, plus maybe also the Dodge. This Dodge stuff, you know, is starting to create maybe a Dodge-led bond rally. Who knows? But again, you know, simplifying things, when you have double-digit earnings growth plus bond yields coming down, you know, to make it simple, you know, this is bullish equity market, and I think this is why we have seen this resilience on the equity side.
bullish, but are you preparing for something really volatile, Charles-Henri? Is that the future? JP Morgan saying that 2025 will be volatile because of tariffs. So are you making that same assumption, and what protections are you looking for in 2025?
Yeah, so I think that's the only certainty for this year is going to be volatile, and I think that we're off to a strong start. And look, you know, it has only been 15 days with Mr. Trump, and I don't think that there is any disappointment in terms of, let's say, the amount of news we're getting. So yes, we prepared ourselves for a volatile year. We need to use volatility at our own advantage, at the advantage of our clients. So that means being nimble, using pullbacks as an opportunity, but also being prepared to be more diversified, you know, within our portfolios. I think the big difference between Trump 2.0 and Trump 1.0 is that investors back in 2016, 2017, they started these new terms of presidency being quite cautious. This time they're overexcited. So if you look at the positioning of the futures, for instance, it's, you know, the highest ever. So that means that there is some risk. And you remember, you know, NVIDIA, you know, 10 days ago, down 17%. Why? Because everyone is in. So when everyone is in, you know, in a few stocks, you need to diversify, get prepared for any bad news coming in.
And how much? So a lot is being driven by sentiment around some of those big tech names. The Mag 7 and NVIDIA is a really good story and a poster child there. A lot's being driven by Trump's policies and expectations. How much of the market sentiment is being driven by the Fed, or is the Fed just following, like everybody else, what is being delivered by the White House?
I think that now it is in the price that there is this fiscal dominance, and that the Fed anyway doesn't have loose hands, and that they are influenced by this fiscal policy. So I think it's fiscal policy first, and then the Fed will try to, you know, manage this. Again, I think that the comments by Scott Bessent yesterday were quite interesting when they say that, you know, basically they're not focusing on the Fed, but they want to do something on the 10-year, which makes sense when you look at the Treasury issuance schedule for the coming months. But I think that was quite well received at the market, and the reaction from, you know, on the U.S. Treasury side means that, you know, the markets are giving some credits on this.
So it means, what does it mean to you? Does it mean we don't need to worry about overt political intervention in what the Fed is doing?
Yeah, I think the Fed, you know, they don't need, let's say, the pressure from Mr. Trump to take into account that there is fiscal policy which is driving their policy. And, you know, by the way, it's not just in the US. In the UK, you have the Bank of England today. They need to take into account the fact that there is, you know, a fiscal policy which is not giving them all of the leeway that they should have.
The narrative at the moment is America good, Europe bad.
Yeah.
Okay? Yet the numbers don't stack up year to date, okay? So currency adjusted, the DAX is up 9% year to date, okay? We're early in February, 9% year to date. I've got this in euros. The S&P is up 2.8%.
Yeah.
Okay, so Europe's massively outperforming
the
the United States year to date. Does that continue?
Well, we have been positioning for this, let's say, rotation, but also broadening of the global equity market advance. We think that for the global equity market to move up, it needs to be, market breadth needs to improve. So we're not that surprised. I think that the positioning that you mentioned is extreme. Everyone is all in US stocks. We're talking about 2/3 of the market cap is coming from one country. So having some kind of, let's say, diversification and advance in other region is probably a good news. I think also that what the market is taking into account is that this time the Europeans are prepared for tariffs. The package is already there. They are ready to potentially decrease the tariffs.
That's a bad thing, isn't it? That will reduce growth, not increase growth. Yes, they can respond, but that doesn't sound like it's positive growth or inflation.
Yeah. Plus, if you look at the European equity, framework, is that we are talking about ECB, which will be forced to ease anyway.
So is the DAX's outperformance an ECB trade? What is it that is? What is it that's getting a near 10% rally in German equities year to date? Germany doesn't look great economically at the moment.
No.
The US apparently does look great economically, but it's up by 2.8%.
Yeah.
What is driving that, and can it continue?
Well, first, there is a massive gap in valuation. The gap in valuation is extreme.
But that's been there for a long time.
Yeah, but now it's probably getting to the point that indeed the value, let's say, seekers are looking at it. Two, earnings growth is decent because many German companies are influenced by what is happening outside Germany. So yes, the domestic economy is not great, but the global growth is okay. The fund flows are responding to this because you can see very strong fund flows going into European equities. China, there are expectations that it might improve.
Okay.
So there is a confluence of factors positioning again, which explain this.
Great to see you. Yeah. Thanks for stopping by to see us.
Thank you.
We always appreciate it. Charles-Henri Monchot, CIO of Seas Group. Thank you. Core 6 looks like this. Let's take a look at some numbers, see where the centre of gravity is here in Europe this morning. You do see pharma strong, tech broadly strong, Ferrari bouncing back a little bit, but you can see SML and Schneider both up. Luxury's having a tough day. LVMH is down, Kering certainly under a little bit of pressure. Let's get more details as to what is happening out there. Joe Easton with the details.
So we've got a decent move in Maersk today, Guy, over in Copenhagen, rising almost 9% at the open of trading. Remember, we've got that buyback for the company. Also, the executive on the show earlier talking about potentially more travelling through the Red Sea potentially in the future, but it does look to be the buyback boosting that stock at the moment. Those rates still quite elevated in terms of the shipping rates for that one. Then in terms of the health stocks, a couple on the radar today. We did have AstraZeneca out of London looking pretty steady on their oncology pipeline, a bit of vaccine weakness, kind of what we saw with GSK as well. But Healthineers in Germany rallying on their MRI scanner business. That does look to be boosted by China. China seems pretty strong from Healthineers, spun out of Siemens. Obviously, Siemens still the main investor in that one, so that one doing well this morning. Then in terms of another couple that we had on our radar, we were looking at SocGen, of course, in banking. It does look like the rates boosting that stock once again, and also a bit of easing on some French concerns. That is a decent move for that one, up almost 8% now for that one. A decent dividend for the company, though slightly below expectations, but looking pretty strong in terms of the banking stocks for SocGen. In terms of Ørsted, it's a rebound story for this one. Of course, it's been very weak on worries around all those US projects and the write-downs that we've seen over there, but the numbers in terms of the cash flow looking pretty steady at the moment. They are, of course, reducing their investment spending, though, and that potentially meaning lower costs. Potentially that is a positive in terms of their balance sheet for Ørsted. So we're seeing that one coming up 3.5% at the moment, a decent gain for Ørsted. Volvo Cars, though, that one looks very weak in terms of some of their sales numbers this morning. That was actually expected to be weak, but it does look a little bit worse than expected, missing expectations on the income for Volvo this morning. So that one does look like a decent decline on the car sector today. Then finally, a brutal one over in chips. I was waiting for this one to open. I'll wait to see if we've got it. We've got a big unch on the screen, so we haven't got a trade, but Soitec, take my word for that, that one is going to get slammed today as they downgrade their margin guidance in terms of the chip maker and sales as well. French company set to drop by a lot. ST Micro had a downgrade over at Bank of America as well. They say they prefer Infineon. Infineon here gaining incidentally, continuing that rise following the results. Remember, we had some weak reports overnight from Qualcomm and ARM Holdings as well, potentially accounting for some weakness in some of the other stocks. But ST Micro slipping. Soitec is set to be slammed at the open when that finally opens on the Paris market in a few moments.
Joe, thank you very much. Yeah, still halted, still not open over in Paris. It took quite a while to get those overall markets open this morning. Lots of news flow going through. Joe Easton from our equities team, thank you. And we'll keep an eye on the Soitec share price when it opens in Paris. Thinking about Paris, Chrissy, we're also watching what's happening at Kering in the luxury sector. The stock down by 2.6%. The Gucci owner changing it up in terms of creative director. Sabato De Sarno is out, and they appointed a new CEO at this part of the business at this business recently, and just in January, in fact. So making some changes.
And it's coming just after months that we had the lowest profit warning from Kering back in October. Yeah. We've been trying to have a big kind of turnaround at Gucci as well. Haven't really seen that. And this is I mean, I know you follow this very closely, Gucci's design trajectory, I'm sure.
Let's talk fashion.
Let's talk fashion. We should. But there was a minimalist look from Gucci that didn't quite land the consumers that they, I think, were targeting.
You just got to listen to Andrea Felstead, right? Okay? So what is Andrea Felstead telling us? She is telling us that brands are back. You want to be big, you want to be brash, you want to get your logo out there. Logos are going to be back.
Is the word.
Quiet luxury is over.
Right, well, that should be good for Gucci, so maybe this marks a turnaround.
Well, so Michele beforehand was kind of flamboyant. He was definitely out there, much kind of bigger, bolder. You come in, you do a bit of quiet luxury, and that's not landing, as you say. So maybe we need somebody who's going to push the brand. Lots of Gucci logo, lots of big kind of logos out there in terms of what they're producing, and that might work with the crypto story.
That might, if the bling is back. And thinking about luxury spending in China, it was interesting that Pernod, and I know this is a different type of luxury, but Pernod, with their negative statement today, seemed, but the stock is up by 3% this morning. They're talking about ongoing challenges in China. There's a lot less gifting, apparently, in that market and a weak consumer. I feel like we've heard those arguments for a long time. No doubt we will return to that theme. Coming up, we take a look at shipping giant Maersk after that company reported full year and fourth quarter earnings that beat estimates. We got that new guidance, we got a big buyback, and we will get an update there on the global tariff story as well. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stradwatts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg brings you breaking news 24 hours a day. Powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Maersk, the shipping giant, up by 8% this morning. We spoke to the CEO just a few minutes ago. The outlook really depends on what is happening with the Red Sea story and whether or not they will be able to regain access to that critical waterway very, very soon, leading up to the Suez and obviously accessing Europe, a much shorter route than going around the Cape. Brendan Murray joins us now, leads our global trade coverage at Bloomberg News. What do we take away from Maersk this morning? What are the key kind of things that we should latch onto?
I think the key message from the CEO of Maersk was that it's going to be at least the middle of the year before they start turning their ships around and going through the Red Sea. And he even said that it could be all year that they could be going around the Red Sea. They just don't know. He said
because the worry about the Middle East, but the Iran connection also is something that's clearly on his radar screen.
Exactly. He brought that up specifically. The instability in the region. We saw President Trump's disrupt the geopolitical situation with his comments about the U.S. taking over Gaza this week. So there's a lot of things stirring in the region that would worry a company like Maersk when you have the kind of assets that they're sailing. They can't take the chance of being attacked like some other ships have.
We just spoke to Vincent Clerk over at Maersk, and he put a real emphasis on the fact that the Forex can offset the tariffs at the moment. So that is a bit of a pause. He said the bigger risk was from the shipping space, specifically the de minimis rule over in the States, that could have a bigger effect. Can you just walk us through that, especially in context of the fact that we've got Amazon earnings coming later today?
Yeah, exactly. So the de minimis issue in the U.S. is sparked a lot of confusion. We saw the U.S. Postal Service flip-flop on their decision to whether or not to accept e-commerce from China. Basically, about 2 million packages come into the U.S. every day, and half of those are e-commerce from China. Those are the estimates. If those million packages aren't coming into the U.S. anymore, they're going to have to come some other way. Americans are going to have to figure out they're going to wait longer, they're going to pay more. So it's going to cause the most immediate impact will be in air cargo, but that will ripple to other transport modes. Ocean will have to start carrying some of that as well. Because that channel for e-commerce coming out of China is just not there anymore.
And what does that mean for businesses like Amazon? I know we're looking to their numbers, and it's a wider story than just this. But focusing on this, what does this mean for Amazon?
Well, it would you would think that if you can't get something on Timo or Shine the way you could very quickly before, that customers might jump over to Amazon. So
and their packages don't come in through that particular rule?
Not in the same way that the Chinese e-commerce does. Air cargo is very expensive. Amazon has more of a warehouse, distribution hub and spoke kind of system. The air cargo from China and that the de minimis is hitting is a completely different model, and it's basically been shut off.
It's more direct to those clothing retailers. Exactly. Okay, Brendan, thank you very much. Bloomberg's Brendan Murray with the latest on some of those shipping and global trade themes. Let's get back to the banking sector. We had numbers out from SocGen. They came in better than expected. A buyback in the offing as well, and so all of that adds up to something positive for the shares this morning, up by 7.9%. Joining us now to talk about SocGen and the European banking sector, the results so far from the sector, Bloomberg's Philip Richards, who leads our European banking coverage. Let's get some highlights from you then, Philip. What did you take away from the SocGen numbers?
Yeah, the numbers are good. I mean, obviously, SocGen has gone through an 18-month turnaround under their new chief executive. And fair to say, I think it's been quite underwhelmed so far. The earnings have struggled. The targets set were very low versus their peers. So you could say set quite a downbeat result. But certainly results today show now that turnaround is beginning to take place. Revenues are up 11% versus a year ago, 3% ahead of consensus. So they're encouraging. The buyback coming through shows the management have some confidence. But what I'll say, let's not get too carried away. It's an uptick from a very weak base, and they've got to sustain this for another 2, 3, 4 quarters.
How much of a coiled spring could SocGen be? Like, I was looking at some of the data this morning. Price to book 0.36, ROA 0.2, ROE 5. These are low numbers.
You're exactly right.
If they get it right, how quickly could these numbers lift?
Well, we have seen the share price move very quickly so far today, but as you say, they're still trading at the lowest, the most discounted value of all European banks. So this 7% bounce today is great, but it's a very small movement versus what we've seen over the time. So, BNP, its closest peer, is trading at 0.7 times multiple, so roughly double what SocGen are on. So, and they also had decent results. So that's why I say they need to deliver this several more times until they become level with their peers.
Philip, it's Kriti. Can you just walk me through some math here? I'm looking at some of the biggest kind of movers and gainers in just the last month. And they've been, of course, a lot of the banks, but specifically the banks that have announced the biggest buybacks, but are also involved in the biggest takeover deals. I'm thinking Unicredit, I'm thinking BBVA, I'm even thinking Santander in terms of their record buybacks. How does that math add up? Where's the money coming from?
Yeah, I mean, there's a lot going on in the sector, it's very fair to say. I mean, in terms of the earnings, I mean, the revenues hold up very well. There's basically almost, I wouldn't say zero bad debts, but credit quality, all banks are beating on across the board. Costs have been the one area where a number of the banks have missed. And that's really hit ING, for example, which also reported today. But bottom line is the earnings coming through are better than expected. But of course, interest rates have only just started coming down. And as what's going to happen over the next 12, 18 months, and then can they sustain that sort of growth so far? That's going to be key for them. And then I'll say separately to that, of course, we've got the whole M&A going on in the sector. And if you look at the banks, the Eurozone doesn't have a single bank in the top 25 globally, which is quite an amazing thing to be able to say. And a number of those banks are saying, actually, to compete on a level playing field, we need to build scale. We need to better match those peers. And that's why M&A is very much coming back on the agenda.
Certainly a fascinating one. We'll see how well that sticks and whether those M&A kind of ambitions even come to fruition. Bloomberg's Philip Richards, who leads our European banking coverage there, talking all things. Thanks, Anna.
Let us talk about what's going on with Switek. This one, we were alerted to the probability that this was going to be considerably weaker this morning, and it is. This is a Paris-based wafer maker, so supplying the tech sector, down by 27.9% right now. And the outlook in fiscal 2025, they talked about that. But what is really bothering the market is the reasoning behind this. Some customers are requesting to put some deliveries on hold, worsening trends in automotive and consumer markets. So we've talked a lot about the auto sector and the weakness there, but we're also seeing residual destocking in mobile, as if we still have supply chain issues and too much inventory in that particular space.
We really need to distinguish between an AI chip story,
and this,
and everything else at the moment. What is happening in mobile, and particularly what's happening in autos, and it does seem as if sometimes we get the mix. So ARM's numbers last night, really interesting. They're clearly dragged by the auto. But actually, the AI story is still looking okay. Anyway, I just think it's a real divergence that we're seeing at the moment. Anyway, coming up, we're going to speak to the CEO of DNB, Norway's largest bank. Fourth quarter earnings beating estimates this morning. We'll get a view in a moment. This is Bloomberg.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive in internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg. Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
This is the opening trade. Let's talk a little bit about the bank sector. We continue to get earnings from both sides of the Atlantic when it comes to the broader sector, but banks very much in focus. SocGen today, we got Santander yesterday amid a slew of M&A and banking news. But when we look at how European banks are trading, especially when it comes to their price-to-book ratio, they are not anywhere near their American peers. That's what this blue line really suggests. They've been making maybe tangential progress, but I wouldn't really call it these bigger gains that we're seeing in the U.S. space when it comes to that price-to-book ratio. But when you look at the stock market on the surface, some of the banks, at least in Europe, are rallying in a really big way in just the couple of weeks we've had in 2025. These are the four biggest stocks, the four biggest weights in the stocks banks index right here in Europe. You can already see up to 20% gains in just about 5 weeks' time. But why is that when we're talking about M&A palooza for a lot of these names? Well, it comes back to the buybacks and the dividend story. They're sitting on piles of cash. They're returning to their shareholders in a really big way. The total number for 2024 for the buyback story was about 30 billion euros. We are 5 weeks into the year, and we've already seen announcements from 6 of the biggest lenders to the tune of 24 billion euros. Guy, Anna, this is an enormous game changer for some of the European banks. We'll see, though, if they have the momentum to keep it up for the remaining 11 months.
Let's talk to a bank that has a price to book that is positive. North of 1.4, I think, is the number I just saw on the screen in front of me. Kirsten Brothen is the CEO of DNB. It's Norway's largest bank. It's out with numbers this morning. The stock is up by 1.7% as we speak. Good morning.
Good morning.
Happy with these results? As I say, you are an anomaly in certain ways in Europe, in as much as you do have a positive price to book. Your EPS is pretty strong. I know that's a key metric for you. Where is the business right now in terms of the things that you can do to keep these numbers moving along? Is it about costs? Is it about driving new business? Is it about what's happening in the mortgage markets and what is going on there with the risk weights? What is it that you are focused on at the moment?
It's really a combination, and the fact that our business is doing so well with a 19% return on equity reflects that the Norwegian economy is doing well. But we do expect to continue to deliver profitable growth on the lending side. We expect a growth in fees and commissions north of 9%, primarily related to investment banking and asset management growth. And continued cost control is important. We are currently at 35%, so we have to work on all the metrics.
So where are you going to grow? Where does the growth come from?
We will be growing in the mortgage market and the SME market in Norway. When it comes to large and international customers, we have an international platform across energy, seafood, and renewables as some examples where we're active also globally. And this works as a growth platform for us when the Norwegian economy is slower.
Yeah, Kirsten, good morning. Let me ask you about the Norwegian economy, because you mentioned that mortgage activity might play out well for you. That's an area you're growing. But I also read that levels of saving in Norway have been high in recent years. Any sign of that changing at all?
No, there's a structural change going on in the savings markets in Norway, where there's been a couple of reforms that are still working. The fact of going from defined benefit pensions to defined contribution, the fact of an increasing awareness that people need to save individually for retired age. We have made saving very much easier on our digital platform, but we still see that Norwegians save a lot less than our Swedish neighbors. So there's more potential, and definitely expectations that savings will grow more than GDP for the coming years as well.
Well, let's talk about the other piece of all of this, which is, of course, rate hikes and rate cuts. Traditionally, with the higher interest rates, it also means higher profit for banks like yourself. But there are rate cuts on the horizon from Norges Bank. Are you preparing for that? How does that affect your bottom line?
Well, as net interest income has gone up with rates going up, there is likely to be a negative impact when rates start moving downwards. But we've had 14 rate hikes, and we are looking to now probably 3 rate cuts in the coming year. Beyond that, we will still be able to grow profitably. We continue to grow our fees, and it's a competitive and well-functioning market. We will still be able to run a very attractive business, even if rates go down from 4.5 to 3.75.
And how does that all hold up in the face of some of the geopolitical volatility that we're seeing? Norway isn't a part of the EU, of course, faces a lot of the same inflation export risk coming out of the States as well. How are you thinking about that?
Well, I think in general, we need to acknowledge that uncertainty is higher than normal, and Norway is a small and open economy that is impacted by what's going on in the world. Having said that, we are a part of the European Economic Area. We have access to the single market in Europe, and we are Europe's largest supplier of energy. So Europe is our most important trading partner, and I think we are an important trading partner to Europe as well.
Last time, though, Norway got a carve-out. Norway wasn't affected when the European Union was affected. Do you think it'll be different this time around? Do you think is Norway effectively part of the EU when it comes to any trade negotiations that exist between Washington and Brussels?
Well, Norway is not by definition a part of the tariff framework around Europe. But I think there is a common interest from Europe and from Norway to continue having this trade.
How do you think the Trump administration sees Norway? Do you think it sees it part of Europe, or do you think it sees it as a separate entity? I'm just curious as to know what the conversation looks like in Norway about this.
I think we have to focus on our negotiations with Europe and vice versa for that trade relationship. And still, we also have 8% of our export towards the US. So this is also an important relationship that is currently being focused on.
Yes, and the balancing of those two is going to be challenging for a number of nations. What about you've got a new finance minister. You're going to have a new finance minister in Norway, former NATO chief, of course, Jens Stoltenberg. I mean, having somebody like that with that international experience and exposure, perhaps that's useful for Norway to navigate these global trade dramas that perhaps lie ahead. Is that what the financial establishment kind of thinks in Norway?
I think all of Norway thinks it's positive that Mr. Stoltenberg was willing to take on yet again the finance minister responsibility for Norway, and indeed in the world that is more turbulent and dynamic than we've seen in a while, having international relations, having a dialogue, talking to each other, negotiating the best possible frameworks is going to be important for Norwegian businesses and for Norway as a whole.
You talked about your Swedish neighbors earlier in the segment. I believe DNB announced a buying of Swedish Carnegie Holdings. Do you have an update on those merger proceedings?
Yes, we are excited about this. We are buying Carnegie, which is a well-reputed and a leading Nordic investment bank. We have received now the approvals that we need on the competition authority side. We are waiting for the final FSA approval in Norway, and we're ready to close sometime in March and April, and looking forward to building the business together.
Do you think consolidation is starting to really get going in Europe, in the banking sector? It was interesting, I think, was it BNP's finance minister, CFO, trying to get the words out, said there are too many banks in Europe. He said that to us earlier this week. Are there too many banks in Europe?
I think there's definitely a lack of scale in Europe, and that many would like to see more European banks among the top sized banks in the world. So fragmentation is part of the issue. I think that is behind a lot of these discussions. Having said that, I still don't think it's easy to merge large banks across geographical borders in Europe, and this is why
what needs to change?
Well, there needs to be a more integrated capital market union. I think Europe has succeeded with robustness and solidity, but the lack of profitability is why all the owners are excited about getting their cash back. And Europe needs private capital to grow and and invest.
So do we need a capital markets union and then more M&A to help them to trade above book value? Is that the secret? Is that what you've learned from running a business which does trade above book value?
I think, well, Norway is a small market, but it's a very well-functioning market. I think there are probably many more elements, but having a more integrated market and a larger market and scale, certainly that's important to build business.
Okay. Kirsten, thank you very much for joining us. Kirsten Brathen, the CEO of DNB. And staying with the banking sector, we have another great conversation coming up with the Intesa Sanpaolo CEO, Carla Messina, will be joining the Bloomberg team. You can catch that exclusive interview at 9:40 UK time. Coming up on the programme, we head outside, literally outside this building, to the Bank of England for insight into today's Bank of England rate decision. We'll get the decision at 12, then the press conference half an hour later. We'll preview that for you. This is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Markets are looking for a Bank of England rate cut at the next MPC meeting. They'll also be listening to Governor Andrew Bailey for clues on the path forward.
The course of interest rates, the path is downwards. So there's no groupthink on the MPC. Reasonable people can take a different view at this point, and that's exactly what they've done.
Tune into Bloomberg for live coverage of the BOE decision and press conference. It all starts today at noon on Bloomberg. Context changes everything.
43 minutes into the session. Welcome back. You are watching the opening trade. This is what the numbers look like at the moment. Actually, a fairly positive performance out of Europe this morning. Bunch of earnings certainly helping the mix this morning. We've got Maersk out, got SocGen out, we've got a whole load of banks, actually. We've just been hearing from DNB. The focus is likely to shift a little bit later on to what we're seeing in terms of the macro story. Remember, we are one day before payrolls out of the United States. That is going to be a firm focus for the markets. We watched Besant's comments yesterday on what he expects from the 10-year. And today, we focus on the Bank of England, which is expected to cut by another 25 basis points. It's likely to warn that further easing will still be gradual. Remember, the market currently has another 50 bips priced in from here for the rest of the year. Let's get a little bit more detail as to what we should be expecting. Lizzie Burden is outside of the Bank of England. Lizzie, in theory, the bank should focus on inflation. In practice, I wonder how much it's going to focus on the growth outlook. And assuming it does so, I'm assuming that the Chancellor will be paying a great deal of attention.
She will indeed, Guy, not just for those reasons, but also because of her headroom and the implications for whether she's going to need to choose between spending cuts, more tax rises, or breaking her non-negotiable fiscal rules. I don't know if you can hear the violinist, someone's serenading the governor when he comes in, but we are expecting this quarter-point cut today. And in terms of the data, you haven't just got weak growth, you have had a pick-up in inflation, you've also got this rapidly deteriorating labour market after Reeves's budget. So this is all in mind in terms of the decision today. We're expecting an 8-1 vote split, but you could see dissent from Catherine Mann, and you could see her maybe voting actually to cut, or you could see Swati Dhingra, the Archdove, going for a jumbo cut if she is that worried about growth. The forecast's really in focus here, though. The spectre of stagflation hanging over the UK economy. We're expecting a downgrade to growth, an upgrade to inflation, and it's going to be embarrassing for the Chancellor, given, of course, that growth's the top priority, given they may see that inflation is worse because of her payroll tax rise in the budget than was initially thought. And as I say, there is the headroom question and whether she faces a difficult choice in March.
Do you expect Bailey will address the impact of tariffs on the UK economy? Is that something that's going to come up?
I'm sure it will at the press conference, Critty. Andrew Bailey loves to talk about his passion for free trade. But in terms of the impact on the UK economy, at the moment, it seems the UK is going to avoid Donald Trump's tariffs directly, but you'd still see a hit to growth. And then if we do get hit directly by Trump's tariffs, our economists say you'd see the growth impact, but also a rise in inflation. So that would tie the Bank of England in a knot, because it couldn't come to the rescue of the economy as easily. So I'm sure that will come up. But either way, you could ask whether these forecasts are already too rosy, given that they can't factor in a policy that doesn't yet exist. And of course, everybody bemoaning the uncertainty around Donald Trump's policy.
Lizzie, thank you. Bloomberg's UK correspondent, of course, Lizzie Burden, outside the Bank of England. Let's continue this conversation. Nina Scario, CEO at the UK's Centre for Economics and Business Research, joins us today. Nina, very good to have you with us. So in terms of the state of the data and what that tells us the Bank of England should be doing, we have had a narrow return to growth in November, but coming off some weaker growth data in a couple of months before that. Some signs of weakening in the labour market, although some of the official data a little difficult to read. What do you think the underlying state of the economy is saying right now in terms of what the BOE should do?
I think overall the state of the economy is relatively poor. I think, sort of on the stagflation conversations, you need the three ingredients. You need low growth, you need high unemployment, you need high inflation. And, that first one on low growth, that's definitely check. There's been a couple of months of growth in the last couple of years, so, roughly. So it's not a great situation. And, the Bank of England would always emphasize that it's data-driven, that we need to see what the future releases are saying. But if future releases are pulling you in opposite direction, if you have inflation, which is persistent, which is actually probably going to be accelerating a little bit in the coming quarters, and you have low growth at the same time, you need to pick the priority. And I think their focus will be more on the low growth side than on the inflation side.
Okay, and will that might worry the bond markets, was the view we got earlier on from BMO. We talked to Lawrence Mutkin from BMO, and he was saying, you know, the bond market wants evidence that they are laser focused on inflation. Yes, they have a secondary mandate around growth, but laser focus on inflation is the thing that bond markets care about, and we know that bond markets can be jittery in the UK.
I think it's going to be a wide set of priorities there because they have a lot of different audiences to please. I think if you're hoping for a laser focus on inflation, you're probably going to see some wavering from that element of the mandate, especially as what we have in the next couple of months are probably going to be the really big impacts from everything we heard in the budget, which people are sort of doing their best to guess what the impact is going to be, but nobody really knows exactly how businesses are going to adjust. And I think they're probably going to adjust a bit more than the likes of the OBR and other factions of the government think, given that their estimates tend to be probably a little bit more static than they should be.
Do you think the labour market's beginning to scare the Bank of England? You get to a point normally when you see a downdraft in employment that starts to accelerate quite quickly. How close to that point do you think we are, and how nervous do you think the bank is?
I think the bank is probably pretty nervous and has good reasons to be pretty nervous. And that's because the signs that the labor market is loosening are already abundant. And we have yet April to come, yet the impact of the hike in employer NICs, of the higher minimum wage. So the labor market is already very firmly, if you look at the various independent trackers out there, they're pretty unanimously saying, especially the ones that weigh more heavily on employer intentions, they're all looking pretty downbeat. And the official statistics have been a little bit problematic here in the UK the last couple of years, but all of the sort of second best sources of data are telling us that the labor market is looking pretty loose.
Okay, so they're worried about growth, they're worried about the labor markets, maybe downplaying, de-emphasizing inflation, but as you say, inflation is potentially re-accelerating over the next few quarters. Is there a point at which inflation kind of starts to supersede and overshadow even the risks that come from growth? Is there a kind of line in the sand, do you think, that actually the bank has to refocus and say, actually, inflation needs to be our overarching priority once again? We'll let the government deal with growth. We have to focus on this. Is there a point we get to?
I think something that could turn the tables there is something that you've been, of course, mentioning a lot this morning is tariffs. And I think it's hard to know what the impact of tariffs is going to be. It could push up inflation, but then it also could push down growth. So there's, again, that question of where the focus is. I think unless there is a big inflationary impact in the UK from tariffs, I think even from that situation, the bank is still going to stay focused on growth. But I think that's probably the most likely factor. If that's more inflationary than I would expect at the moment, I think that's what kind of rechanges their focus.
Nina, where are the pressure points coming from outside of the UK? We talk a lot about China data affecting inflation in Europe, America affecting inflation in Europe, but there's a narrative that the UK is almost insulated from those external pressures. To what extent is that true?
I don't think that's true at all. I think the UK rhetoric can really often overestimate sort of UK's level of insulation from what's happening in Europe, from what's happening in the US. I think the scale of what's happening in the United States and the possible things that could be triggered if there is a sort of a more all-out trade war, I think nobody is going to be insulated given the significance of the United States to the global economy. So I think the UK is actually incredibly dependent, and it is actually a services exporting powerhouse. So the idea that it can be insulated from what's happening abroad is...
The danger here, of course, is, and we've seen this recently, is that you end up in a situation where the market doesn't believe. And if the market doesn't believe, like, it doesn't impact the front end, but it does impact the back end of the curve at a 10-year level. And that's where we've already seen kind of a few pre-shocks in the UK. And the danger is that if the governor, to Mutkin's point earlier, Lawrence Mutkin's point earlier, doesn't focus on this, isn't there a danger that actually we end up with a 10-year that rockets higher, and actually we end up in the worst of both worlds?
That's a very doomsday scenario.
But the UK, we've seen a series of these kinds of events in the UK.
But then they always come back. They always kind of collapse on the narrative that there's fiscal stability in the UK, right?
I think the fiscal situation is not, at its worst point. It's certainly not at its best point. You often still hear this narrative of what should the chancellor do, given that the forecasts are probably not going to come right. Should he increase taxes more? Should he cut spending? But people have to remember, like, very fundamentally, there is a limit. You can't just indefinitely
How close to that edge are we? How close to that edge are we? If the chancellor doesn't deliver, could we see another bond shock? How big a risk is that? And that completely upends the financial story.
I think it's going to be very precarious. I'm looking already with a lot of trepidation at the next fiscal event, because I think you can only push the system so far before just the whole credibility of basically the narrative you're trying to sell, the confidence, the economy. And I think she's getting quite close.
Nina, thank you very much. Nina Scaro, CEO at the Centre for Economics and Business Research, with a look ahead to the Bank of England. And we will be bringing you full coverage of the Bank of England decision at 12 o'clock and Andrew Bailey's news conference. That's at 12:30. Chrissy.
Let's go from the UK to what's going on in Germany. We're, of course, just days away from the German election now. And a new poll has shown a fall in support for the Conservative alliance led by Friedrich Merz. It follows a disputed vote in Parliament, which saw the frontrunner for Chancellor forced to rely on support from the far-right. Bloomberg's Oliver Crook joins us live from Berlin. Ollie, walk us through the details.
Yeah, so listen, this is after the big gamble that Merz made last week in voting with the AfD, the first time a mainstream party has voted with the far right since the end of the Second World War, which of course alienated the great many people and the other sort of parties, but also some of the centrists within his party. The main problem for Merz was, even for those who were sort of on board with this within the party, saying that maybe it was okay that he was voting with the AfD, taking a bit more of a pragmatic approach, this piece of legislation failed because he couldn't get his own party in line. So from even that perspective, it came out very poorly for him. And you're starting to see that illustrated across the polls. You see it there on your screen right now, the CDU coming in at 28%. That is losing 2 points from the last week. And if we keep those polls up a little bit, you can see that what he was trying to do was to undermine support from the AfD, pull them towards the CDU. He failed to do that. The AfD is dead flat, but some of that support has trickled down to some of the smaller parties like the Greens and Die Linke, the far left. So the consequence of what we have had is basically A, undermining the sort of front-runner status of the CDU, but B, also dispersing those votes more evenly across the political spectrum, which basically builds on one of the main political stories here in Germany. One of the main problems, frankly, no matter where you sit on the political spectrum in Germany, is that there is more and more fragmentation. And as all of these sort of parties converge around 20% heading into the election, you're basically setting up the same scenario you had last time with dysfunctional coalitions that ultimately brought the last government down.
Draw a line to the auto sector for me, Ollie.
I always would like to, because that's always what it sort of comes back to here in Germany, within politically and culturally. What we are seeing is something very interesting, is we had sort of Elon Musk weighing in on the political situation, backing the AfD, the Alternative for Deutschland, and now it seems the Germans are looking for an alternative for Tesla, because we saw Tesla's sales plummet in the month of January, down almost 60% to the lowest level we haven't seen for many, many years. And you could say, hey, maybe this is just EV demand. But EV demand overall in Germany was up 54%. You're seeing it across the board. Same thing happening in France, same thing happening in the UK. And when you ask the Germans, they did a poll on this, on whether or not they have a favorable view of Elon Musk. That has really shifted. About 80% of people in Germany say they do not have a favorable view of Elon Musk and really don't want him to be involved at all in German politics.
Ollie, great stuff. Thank you very much indeed. We've got plenty of great coverage coming up on this subject. Tom McKenzie will speak to some of Germany's most powerful business voices ahead of the election. He's going to do, well, the election is later this month, the German election CEO briefing coming up at 9 a.m. London time, 10 a.m. in Frankfurt.
Let us just get to some of the shares that are on the move this morning. We have SocGen climbing. We got a buyback there, better than estimated numbers. Retail banking in France, certainly in focus. We also see Maersk is moving higher this morning. Some really big moves on the back of these numbers today. Again, a buyback coming through from that business. And that's playing out well for the company. And the guidance, renewed guidance, very reliant, though, Guy, on what we get from the Red Sea and how quickly they can get back there.
Yeah, caution, though. Definitely caution. Let's talk about Soitec. Let's talk about what's happening in the chip space. We are seeing certainly a big downdraft in this company. You need to differentiate between what is happening in the auto sector and what is happening in the AI trade. Soitec certainly taking a big hit this morning. The Pulse is up next. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Germany heads to the polls in just over 2 weeks, and the country's economic challenges are an overriding election theme. Over the coming 30 minutes, we'll speak to some of the country's most powerful business voices to find out what's needed to get Europe's biggest economy back on track. Well, Bloomberg's Tom McKenzie is in the financial hub of Frankfurt to get answers from leading chief executives. Tom.
Francine, thank you so much. Yes, who better to speak to about the health of this German economy and the policy prescription to revive its fortunes as we head to these crucial elections than the CEO of Bilfinger, Thomas Schulz, the CEO, of course, of RWE, Markus Kreber, and the CEO of Commerzbank, Bettina Orlopp. Thank you so much all for taking the time. Let's start on the health of this German economy. We know the broad sweeps. 2 straight years of contraction for Germany's economy. A year as 2025 where the Bundesbank sees growth of maybe 0.2, maybe 0.3%. You all have your fingers on the pulse of different parts of this German economy. What is the current state of Germany's economy from your perspectives? And I want to start with you, Bettina.
Sure. So, I mean, we have a very similar opinion. So our forecast, GDP forecast is also 0.2%. And clearly we hope that the new government might send some impulses so that this one is improving over the year. But for the time being, we also assume that this will be the growth rate for 2025. And what we see is high resilience, actually, which is good. So if you take last year, 2024, we saw only really single engagements falling apart, and the rest was very stable, very resilient, and corporate clients really did their homework and were pretty safe. And I mean, the problem we really have is that they do not invest in the moment enough. And that needs to change. Otherwise, we really have a problem in the coming years, because without investments, we all know we won't see any growth.
Okay, so 0.2%, you're seeing some resilience. You want to see that investment picked up. Thomas, from your perspective, the clients that you service, are you seeing that resilience, or is there pain across your sector?
Actually, we go through all the industries in Germany. We make service on all industries beside automotive. Otherwise, we are everywhere. And we see that all our clients are actually on a good track to make their internal improvements, cost base, lowering bureaucracy and so on. We think actually in the next few years German industry will perform better based on having that pressure at the moment. But the short-term view is not positive. Lack of investments, too high pressure from unorganized political decisions in the last 2 to 3 years really is a big concern for the industry.
Marcus, we cannot talk about the health of this economy without talking about the energy input. From your perspective, what are you seeing right now in terms of the demands and the pressure across the energy space?
So what we see is, two different topics. One is the cyclical side, and we see weakness because energy demand from the German industry is low. It's structurally lower, I would say 15% pre-energy crisis. And that has two elements. One is, the cyclical weakness. We are an export economy. China is not doing well. But we also have fundamental structural problems. We don't see investments. Nobody is actually looking for long-term energy supply needs because there are no big investments plans, and that comes down to the structural problems which urgently need to be addressed.
The structural problems need to be addressed. Investment is something that you've all touched on. Bettina, across the Mittelstand, which of course you service, are you seeing pain there? Are you seeing a pickup in defaults? How much resilience are you seeing in the Mittelstand at this point?
Actually, as I said, we don't see it in the moment because they have been very conservative in their investment plans. But we all know that there are big challenges ahead of all of us with respect to digital sustainable transformation, and we need to invest. We also need to invest to see innovation, because without innovation we do not see growth. So we really need to make sure that the sentiment is changing, because I think there will be investment, but only if the Mittelstand also has the feeling that there is a stability, political stability, a stability in decisions, that there are reforms with respect to tax, with respect to bureaucracy, all these things we are talking about since years now, and we think also you can change pretty quickly the sentiment. So there's hope that if we have a stable government after the election, that we will quickly see a shift in sentiment, and then we will also see more investments. Actually, we see also investments, but unfortunately they do not happen in Germany, so they go abroad. We see investments specifically in the US, but also in Asia. So it is not that our corporates are not investing. You see it also in our loan growth. We had quite a significant loan growth last year because there is demand, but unfortunately it's not happening in Europe.
Okay, so it's possible we do get that political stability in a few weeks here in Germany. It's possible you get a turnaround in sentiment. What is the broader prescription for rejuvenating this economy, for making Germany great again? Marcus?
Before I now list all the topics where I think we need structural change, let me say I think I've never experienced that the sense of urgency is that high. So there is really the pressure to change. So I'm optimistic that it's going to be addressed. But what needs to be addressed? One thing is we need to free up market forces. There's too much detailed regulation, too much bureaucracy. Second is we need to get the labor market more dynamic. There needs to be clearer incentives to work more, work longer. Third one is all the investments in infrastructure, transportation, energy, digital infrastructure. And then, of course, the investment and innovation environment. Capital market unions across Europe is needed. More money for private equity, for startups. And lastly, as Bettina said, also on the tax side, Germany is one of the highest taxed countries.
It sounds like, Marcus, I don't want to stay with you and then I'll broaden it out, because you're hitting on a lot of policies that the current Trump administration are working through. Tax cuts, working longer, more people working longer, innovation, digitalization, investment and regulation. Does Germany need an Elon Musk, a Doge, a Department of Government Efficiency to cut regulation?
I would say we definitely need to address the topic. Whether it's that approach, let's see how successful they are. If they are successful, let's copy it. Otherwise, we go our European way.
Thomas?
At first, I would not put a comparison with US. It looks always similar, Europe and US. It isn't in the way how they do it. So I would not say we need an Elon Musk. At first, we need in Germany to have a closer cooperation between politics and economy and the business. That is completely so far away. I never saw it in an industrialized country so much as in the last few years. So out of that, all what we heard now, what to tackle, are actually European themes too. But in Germany, we have all of them. We have all of them. We have to stop to make own decisions only for Germany. We have to look more into Europe and to drive that. A big part of that is, I take only the labor and the incentive for going to work. Germany works in average less than 35 hours per week. Less than 35 hours per week. And this is the third lowest in the European Union. If we would increase with the right incentives and lowering to incentivize not to go to work, then we could come easily to 37, 38, which is average for Europe. And a lot of the problems of the skilled labor shortage, what we have, is gone. We have the education, we have the specialists in a large extent, but we need to work longer. And that needs a political decision to go ahead and to make the right, let's say, political framework in Germany that we get it through the society. We are actually in a situation in the last 2-3 years where we talk about all the problems, but nothing happens. And the industry reacts on it by not investing. Our netto invest in Germany dropped from minus 47 billion euro per year under Mrs. Merkel to more than 110 billion under Mr. Scholz. And that should be a warning signal to each and everyone, and that is ongoing for years. But I agree, the hope, actually, the trust what we have is with a change and a little change of the political spectrum and a real economy and politics together, way of working, we can really change the tide and going back into growth.
Bettina, on the question then of how to attract that investment into the German economy, and I'm going to assume and make a bold assumption that you work far more than 35 hours per week. To get that investment, you need a competitive banking landscape. Yeah. European banks are not competing with US banks anywhere near in terms of the margins and profit and revenues, net interest margins. US banks are outperforming European banks. Just broadly, as a prospect, as a thesis, as an idea, do you agree that consolidation in the European banking space is needed to create larger European banks that can effectively compete with their US counterparts?
Well, that's a nice way of articulating that. Yes, I mean, we need consolidation, but cross-border consolidation in Europe only works if we have a banking union. So we need to start with a European-wide deposit protection scheme. And if we have that, then also cross-border deals become much more attractive because we can really shift liquidity and capital and other resources across the countries. And because that one is very far-reaching, we always support the capital market union to start with, because already a deeper, more functioning capital market during the capital market would help already Europe, and we really need to activate our private capital, which we don't do. I mean, look at Germany. We are unfortunately a country of savers and not investors, and we need to change that. So we really need to increase financial literacy here. We need to convince the people that it's smarter to have a securities saving plan instead of leaving the money on their sight deposits and things like that, having private retirement schemes, all these things, because that would activate capital, and this capital can be used for what Markus just said. First of all, financing venture capital, really startups, because without innovation, without startups, we do not get new companies, but we also need to have the financing power for the developed corporates, because the investment need is huge.
Does the next government look and need to re-look at the debt brake in Germany? You have 62% debt to GDP. We have 97% in the UK, 120%, more than 120% in the US. Does the debt brake need to be reassessed by the next government to ensure that there is more fiscal spending? Thomas?
I'm actually surprised about the question, and I'm actually surprised about the whole discussion in Germany. If you look into your money, you look at first what you spend before you increase your thinking about your debt level. Look where you spend the money. And we have not a problem to have enough money available for the government. We have a problem how we spend it. The spending issue is the big thing. If that is sorted out, then to talk about that, what we call the maximum limit of the debt level, can be discussed, no problem. But at first, please, analyze and decisions how we spend the money. There's a lot of money going for, let me say, in all fairness, useless things, not sustainable. And I think there we have to look into. And to be honest, the politicians have to be honest where they spend the money. The amount of government officers in Germany from 2013 doubled. That means from 49 to 2013, the amount what we had is now doubled since 2013 to now. I think we should look into that. It can't be the answer of a government to recruit more bureaucrats if they see an issue to sort out. That can't be the answer.
Marcus, you keep the debt brake or you loosen the debt brake?
I 100% agree. I think the worst thing that can happen, we have a huge advantage with consolidated financials on government level as Germany. Of course, gives us lots of headroom. But the worst thing that can happen is that we now ease all the political problems, finding decisions and taking the tough decisions by opening the debt brake and spend it on consumption. Yeah? So first, I fully agree, we need to sort out where we spend the money. And then, if there are good ways to spend the money on infrastructure investments and the future, then you can address the debt brake. But that order, please, not the other way around.
Bettina?
Yeah, I think I'm also, we need to look at the spending side. However, time is of essence. So I think in parallel, you also need to think about what you do with the debt brake. And I think the important part is that not to find a joint alignment on what is investment, because many times it's more consumption than investment. So investment is really investment in infrastructure, etc. So as long as we can make sure that the new debt is used for real investments, I would support that if in parallel there's a cut in spending.
What would those real investments look like to you?
Well, it's infrastructure investment, railway, streets, the whole infrastructure with respect to energy and things like that, digitization.
To get consumers to spend, you need them to feel more comfortable about their own finances. Energy costs have been a pain point for households, but particularly as well businesses. German businesses, industrials paying 3 times the amount for energy on average versus their US counterparts, twice versus China. Marcus, how do we lower energy prices? What is the prescription there? Do we need subsidies? Do we need tax cuts for the grids? What specifically is needed to lower energy costs?
Let's first briefly look at what are the root causes. We have 2 root causes. One is, of course, we are cut off Russian gas, and we now need to import LNG. That's a marginal molecule coming into Europe, and that is more expensive. That's a structural change. We have to adapt. That is not different for countries like South Korea or Japan. They're always dependent on LNG, and they're still industrialized countries. The second biggest problem we have is underinvestment. For more than a decade, we have now only discussed what we close, nuclear, coal, and so on. We have now made certain progress on renewables, but we still need to have more investments because we have a supply crunch still. And you see that from price spikes we see from week to week. So we need more investment. Second is we need to rely on market forces. There is an over-regulation in the decarbonization path. Actually, we have a European emission cap and trade system that should sort out where you save emissions most efficiently. But we in detail regulate everything we can do, and that makes things slow, more expensive, and by that drives energy prices. And the last thing, we need a bit more coordination and the right incentives, because currently the grid build-out and the renewable build-out and backup capacity are not synchronized. And we have a lot of renewable assets which can actually not get the power to the consumer because the grid is not ready, and that also drives costs.
Are you comfortable taking more gas, in theory, from the US? It's certainly potentially part of a trade deal between Europe and the Trump administration, buying more US gas, or do we become more dependent then? We have the dependency on Russia, that's been eroded, of course, and then we become dependent on the US. Is that a risk?
If you have an import infrastructure which makes you independent from a supplier, when you have LNG import infrastructure, you can buy from anybody, from Qatar, from the US, even from Australia. Shipping was not smart, but you are not dependent. You are dependent when you are at the end of only one pipeline system. Yeah, but with LNG infrastructure, we are not dependent. Let me ask the first question you said with a nuance. I think even if we get everything right on the energy side and make it more efficient, and cheaper. I think the energy-intensive industry still needs structural relief to be competitive staying in Europe, because we have a different decarbonization path in other parts of the world. And I doubt whether CBAM really works. So I think there is a case for some structural relief for the energy-intensive industry to keep it here.
Thomas, does there need to be that relief? Subsidies, tax cuts?
Let me answer like that. Of course, I agree. The thing is, we are over-regulated. And if you are over-regulated, you put all your forces in reporting the regulation requests instead of getting more innovative. We talk about startups, I agree. But when you look into the innovation investment of German industry in the last 10 years, it's permanently decreasing, and other countries are increasing. We work mainly, 90% of that what we work on are existing assets, 10 years, 20, 30, 40 years old. There's a lot of potential to improve. Second, I'm generally against that the politics are putting their hands on the business. The market should regulate it. And that's with the LNG the case. If it makes profit, then we will have the infrastructure and we will have competition on the suppliers. I would not make political decisions on that. I would really open the market for that. Then to the energy-intensive industry in Germany. We have since more than 10 years now a really opposite politics decisions on energy-intensive industry in Germany. And that has a big impact. The question is, if we need energy, and we need energy, we have to be able to forecast it. It can't be that we are 3 times higher in the cost. It can't be that we shut down nuclear power plants and then we have the biggest import out of France ever, nuclear power. It can't be that we as a technology country actually cut off out of moral and political reasons technologies. So what we say is, yes, sustainable green technology is necessary, but until we have it available in a competitive financial way, we need other buffers to serve our high energy industry. Otherwise, it's gone.
I want to get to Bettina, but before I do, I can't let that one go. So, Marcus, nuclear power. Should the next government look at reviving your nuclear power plants? The CDU has suggested they would be open to an appraisal.
Look, the decision has been taken by politicians in 2011. So we know since then that the closure will happen. All the operators have planned for that. So there is no qualified staff available. And I can go.
So you're happy to take French nuclear power rather than German nuclear power?
No, what we need to have a strategy how we actually ensure security of supply and how we replace nuclear and coal. And the ideas are on the table since a decade, but nothing happens. And building 50 gas plants, which is the right thing to do, will only, is probably in the end per annum 3% of the total power cost. It's from a cost perspective irrelevant. Let's just get the investments done. But we are waiting for the framework now, and with another delay because the government fall apart.
Okay, so on that point, there's the interaction between politics and business, and this is being debated here. Bettina, do you feel like, are you confident that the next government, whoever it is, and whatever form and shape it takes, will have your back and support you as an independent bank at Commerzbank?
Yes, I think so. At least, we are in talks with all Democratic Party leaders, and they also all have openly communicated their support and their stance about the approach, and therefore we are confident that we have the support, but we are not relying on it, actually, because we built our own strategy, and we just completed a very, very successful year, 2024. And we are continuing this trend this year, and we'll have an excellent Capital Markets Day next week on Thursday, where we present our upgraded strategy and where we will show that we are very worthy. And
so you've been talking to, just to be clear, you have the Capital Markets Day, February the 13th, really crucial for Commerzbank, given UniCredit's 28% stake in your business. You've been having conversations with Merz of the CDU, CSU, and you're confident that he will support the pushback against this potential takeover?
He has also, all party leaders have publicly stated their support, and our MP here of Hessia, Mr. Ryan, has been very explicit. So we feel very much supported, yes.
How should Germany think about potential tariffs from the Trump administration? How much of a risk is that, Bettina?
It is a risk, absolutely, and I think the most important part is that Europe is prepared, that Europe stands together, and that we have a coordinated response to it. And at the very end, I think it's all about deals. Two parties then need to sit together and strike a deal.
We have about a minute left before we have to turn back to Francine Lacqua sitting in the studio in London. Marcus, before we get there, how should Germany respond to the threat of Trump tariffs?
I would not see it as a threat. I mean, it's probably a start of a negotiation. So be prepared, and we have seen what happens with Canada and Mexico. They were prepared to counteract, and then you start the negotiations. And I mean, but what is important is that we also clearly define our own interests, our European interests, what we actually want. Before you have defined your interests, it's difficult to negotiate on.
Does it change your business plans, Thomas?
No, and I would not call it a threat. I fully agree with Marcus on that.
Tariffs are definitely coming. That's what the president
and then
said.
They come. And then we have to improve, and then we have to get our acts together and doing things faster, because he brings in speed, decision speed, and we need that urgently in Europe. So I don't see that negative.
Are you factoring in mitigation for potential tariffs into your business plans?
My business doesn't have any tariffs in that, because we only supply industrial service, so IP, if you would like to say it like that. So from that point of view, but generally, it's like a business. It's a kind of a competition. If you have good competitors, you grow your business.
Okay. Thomas Scholz, CEO of Billfinger, Markus Gräber, CEO of RWE, and of course Bettina Orlopp, CEO of Commerzbank, staying with us. We're going to hand back to Francine Lacqua right now in the studio in London. The team back in London. Guys.
Tom, thank you so much. What a terrific briefing, a very important briefing to try and understand some of what the chief executives have to grapple with. We did have some good news today about industry stabilization because of the factory orders, but as Tom points out, there's still a lot to be done. The German election chief executive briefing continues on our website as well as on LiveGo for terminal subscribers. We'll also bring you all of the news, analysis, and market moves as we continue to build up to the German elections later this month, including a special program when polls close. That's on Sunday, February 23rd, live from Berlin. Well, the Pulse is up next, and we'll, of course, be covering the fallout from President Trump's comments on Gaza, with most countries in the Middle East condemning his plans. We're also looking at corporate news and earnings season. Don't miss our exclusive interview with the chief executive of Intesa Sanpaolo, Italy's largest bank. That's coming up shortly, and this is Bloomberg.
In case you missed it, on Bloomberg Technology.
It's incredibly aggressive, the timeline to manufacture the first phase of this site and then start production mid-2026. How big a factor was that timeline in Ohio's selection, Palmer?
It has to be this fast because we don't have time for business as usual. The types of threats that the United States is facing, that our allies around the world are facing, the fact that we are predicted to run out of munitions within the first 8 days of a potential conflict with China mean that we need to hyper-scale our manufacturing. We are on a path to being a publicly traded company. I think that's an important thing. I want us to be accessible to the American public. I think that it's good for people to be able to invest in American defense companies, not for them to just remain private forever. I'll take an ideological stand there. I think that is a good thing for the country. It's good for us. It's good for our customer. As for when that happens, it's hard to say.
Don't miss Bloomberg Technology, live every weekday. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The U.S. Treasury Secretary Scott Bessent says the Trump administration is focused on 10-year Treasury yields and not pushing the Fed to cut rates. Donald Trump's aides look to tone down his call for the U.S. to step in and own the Gaza Strip after widespread condemnation. Plus, the BOE is set to cut rates for a third time while lowering its growth forecast and predicting higher inflation. We'll, of course, bring you the BOE's decision when it's released at 12 p.m. London time. Then viewers in the U.K. will see full coverage of the news conference at 12:30 p.m. At 4 p.m., we'll bring you also our interview with the Governor, Andrew Bailey. And then we're also watching events in France, where the Prime Minister, François Bayrou, survived 2 non-confidence motions yesterday, finally ensuring the adoption of a budget following months of political turmoil. But let's begin in Washington. On the geopolitical front, aides to President Trump are trying to tone down his idea of depopulating and taking over Gaza after the comments were widely condemned across the globe, but welcomed by some lawmakers in Israel. On the tech front, Silicon Valley continues to retreat from diversity policies that have fallen out of favor during the Trump administration, with Alphabet the latest company to do so. So to discuss all of these topics, we have Bloomberg's EMEA News Director, Ross Matheson, and of course our Executive Editor for Global Technology, Peter Elstrom. So thank you both for joining us. Ross, the White House is now walking back, Trump's Gaza comments. Are there worries about his new Ukraine plan, which they're set to present at the Munich Security Conference?
Well, that's right. As you were saying, there was a bit of a change in tone overnight on Gaza. That's not to say the US doesn't want to be involved in some fashion, perhaps walking back the initial idea that they would be coming in very quickly, possibly militarily, and they wanted a wholesale relocation out of Gaza permanently. So you can see that that's gone into a little bit of the land of nebulous in the minute. But given that, and given that we are expecting to see the bones, more bones in a way, on the idea of what the US would want with a peace deal from Ukraine as soon as next week at the Munich Security Conference, and what those parameters would be. What this all tells us is that Trump is very mercurial, which we know. He's very transactional, as we know. So he will want something that that he thinks is a good deal, particularly for the US, out of this. And what we understand, that could entail freezing the conflict, which is potentially advantageous for Russia in terms of the land that it's currently occupying inside Ukraine, some sort of understanding around security guarantees for Ukraine, but we don't really know what that might be. It doesn't seem it's going to include them joining NATO, perhaps to kind of help shepherd this through. The US gets access to critical minerals in Ukraine. That's the important part of the deal, really, for the US. But, you know, what we can see on Gaza, but also what we see from Trump in general when it comes to allies and adversaries alike, is that he's going to be very transactional. So the parameters around Ukraine could move and shift.
And Roz, as you point out, I mean, the economy and geopolitics seems to be blurring with this administration, where, I mean, the interview of the month, without a doubt, is David Gura sitting down with Scott Bessent, the new Treasury Secretary. We're starting to have more of an idea of what he wants.
Well, that's right. It's very clear that he's also navigating, by the way, within this new administration himself and all the other voices in Trump's inner circle. But he's pushing very heavily on tax, and that's possibly getting a little bit complicated in Congress. He really wants those tax cuts to become permanent, and that's a key priority for him. He keeps talking about his triple threes, which we all know is, you know, the deficit at 3% of GDP, increasing oil production by 3 million barrels a day, economic growth of 3%. So he needs everything to line up to deliver those, and he's very focused on that. But interestingly to see that he's talking about managing things through the economy and inflation and the yield curve, and not sort of pressuring the Fed. He's quite cautious about that. I think Donald Trump's much more overt about saying what he wants from Fed, but it's interesting to see Scott Bessent saying, you know, I'm going to come at this from a different direction. I mean, that's not suggesting he wants to do overt curve control for treasuries, but that he's going to try and create the conditions for inflation and therefore a knock-on effect.
And Peter, Alphabet, Google is scaling back on DEI. It's just the latest, you know, tech company to try and get rid of some of the initiatives. Is that because the White House is directly putting pressure on them?
The White House is certainly serving as an example of what they expect these companies to do. So, yeah, Google, Alphabet is kind of following in the footsteps of Meta and Amazon, some of these other Silicon Valley companies that have pulled back from the explicit DEI goals. And in this case, Google said they're not going to pursue what they have, these very specific aspirational goals in terms of diversity. This comes with a pretty important legal backdrop, though. It's not just the Trump administration. Before this in the United States, we had the Supreme Court making a decision about college admissions where they said universities, including Harvard and the University of Michigan, could not use specific racial targets for admitting students. Now, some on the conservative side in the United States have seen that as a precedent where they can now go after companies and say, you can't use these same kind of targets in the workplace that you had in the academic institutions, too. So there are some lawsuits against some of these companies, including against Alphabet, as they pull back from this. So the Trump administration is certainly using this as an opportunity to take away some of the DEI initiatives within the government, but you're seeing that carry over into the private sector in important ways.
But, Peter, does it mean that actually they'll go back on it, or that they just won't advertise it?
Well, that's a good question. I think it probably depends on which company we're talking about. Google certainly said that they still feel like this is an important initiative, but they're not going to have the same kind of quantitative goals that they had in the past.
Peter, I mean, there's also a lot of earnings coming from the tech world at a time where there's also so much uncertainty about tariffs.
Yeah, some disappointing earnings from some of the tech world. Certainly some of the chip companies, including AMD and Qualcomm and ARM at this point. You're seeing some softness in the smartphone market, which hit Qualcomm in particular and ARM. It's carrying over to ARM. And the big question that we talked about earlier this week, it seems like so long ago with Alphabet and some of these other companies, is whether these huge investments in AI are going to pay off or not. And I think there are some concerns that if the companies that are investing tens of billions of dollars are not beginning to see revenue growth, then they're going to pull back on their capital expenditures, and that could hit some of the chip companies, some of the others deeper in the supply chain.
And Roz, again, every day there's another story about Elon Musk and his efforts to hollow out the U.S. government. He seems to be pretty effective.
Well, he's certainly found out everywhere, isn't he? And with his Doge associates. But, you know, what we're hearing, obviously, is that so far about 40,000 government employees are saying they will take that buyout offer. But remember that about 60,000 retire every year anyways, 2% of the civilian workforce there. So are these people who were probably looking maybe to retire anyway, or looking at different, and they're taking that as an opportunity? Are you losing people who are going to go anyway? Or are you losing the people who were really smart and you want to keep them somehow in the organisation to some extent. So it'll be interesting to see more of that unfold, exactly who's involved and what that does to the workforce. But obviously, you know, he's in everything. He's looking in the Treasury, in the payment system, looking perhaps at some of the payments that are made out of Medicaid, you know, some of the contracts that are there. So this is just the beginning. He's very, very busy. The question again is, how deep does this go? How much does this shift the budget responsibility in a way over to Elon Musk and out of Congress? And for Bessent too, you know, as the Treasury Secretary, how is their relationship going to unfold? Do we see divisions opening between them potentially about how this goes?
It's really incredible. We could speak about this, just geopolitics, White House, and tech for another 3 hours. Thank you, Ross Matheson, Bloomberg's EMEA News Director, and Peter Elstrom, our Executive Editor for Global Technology. Now, coming up, we speak exclusively to the Chief Executive of Intesa Sanpaolo, as Italy's largest lender announces a new share buyback worth 2 billion euros. That interview coming up next, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Welcome back, everyone. It's been a bumper week for European bank earnings. Now, the Italian lender Intesa Sanpaolo has reported a record profit for the full year, with net income in the fourth quarter beating estimates. It also announced a new share buyback worth 2 billion euros. Well, Intesa's chief executive officer, Carlo Messina, also said on the earnings call earlier this week that he has no plans to join the deal wave sweeping Italian banking. And Carlo Messina joins us now for an exclusive conversation. Mr. Messina, as always, thank you so much for joining us. Look, I know we've been following actually your bank with great intent and looking at the share price. You've always, said you will give higher returns, higher profit, all that organically. So what are the pillars for that growth and the pillars for your strategy?
So, Francine, that we have a business model that is the real winning business model, especially in an environment of reduction of interest rate, because we are a strong wealth management and protection company with the 1.4 trillion euros of wealth of the Italian families, and we are able to increase fee and commissions income, and we will accelerate this increase during 2025, and this will more than compensate the reduction in net interest income. So we are a unique opportunity for investments in diversification of revenues. That's the reason why we think that we will continue to maintain this extra performance in terms of market cap in comparison with other peers, especially during 2025.
And Carlo, again, so this is partly basically taking deposits of clients and turning them into higher yielding assets. Can you give us a flavor of the number of assets that you could do that with?
So we are today with the 1.4 trillion euros of wealth, out of which 600 billion is deposits, and the other part is asset under management and asset under administration. We have more or less 150 billion euros of asset under administration and deposits expiring, term deposits, and asset administration that are capital gain positive. So we have a significant room to increase the fee and commissions income in the organization. And also looking at property and casualties business, we are accelerating, we are becoming for sure one of the most important players in the country, and also in that area we can accelerate absolutely during 2025.
Carlo, do you have a specific target for assets under management for this year or next?
So we think that we can have a growth on a quarterly basis. We have more or less 35 billion euros of gross inflows, and this will remain during 2025. So our estimate is that we can have between 120 billion and 150 billion euros that within a rotation and the possibility to increase fee and commissions on this area.
What's your take on what's happening M&A-wise in Italy? I mean, every day there's something new.
Absolutely. So there's something like Italy is the cool environment for the M&A. So I think that there is, just to give you just a starting point, during 2024, we increased our total customer financial asset by 77 billion euros. So we increased year by year, we're increasing our wealth management for equivalent of 50% of one of the companies that is involved today in the M&A, just to give you the idea of the dimension of Intesa Sanpaolo in comparison with all the other peers. So in any case, any kind of aggregation will create a competitor that will be not so significant for Intesa Sanpaolo. I think that there is a lot of confusion, so that's my personal view on what is happening in Italy.
From investors?
It's a confusion on both sides, because there is a lot of trying to be a leading player also with some approach that is creating confusions in the perception of the investors. And that's my personal feeling on what is happening in Italy. You have a transaction that can have an industrial sense, other probably more difficult to understand. What it is really important at the end is that the market is king. So cash is king, market is king. So if they will be able to demonstrate that they can create value and synergies, then at the end a shareholder meeting will receive the approval. Otherwise, it will not be possible to make a deal.
But Carlo, I mean, from my understanding, you've been pretty clear over, even the press conference earlier this week that actually you don't want a bolt-on acquisition in Italy or in Europe. Why a hard stance? Why a hard no?
So we want to remain a safe and institutional harbor for the international investor. So if you want to rely on a company that can give you a significant net income on a sustainable base, based on the right business model with a significant investment on technology, you can rely on Intesa Sanpaolo. We don't want to enter into execution risk deriving from M&A, because M&A is cool when you make a declaration of OPA, then you have to make integration. So you can be a fantastic advisor, but when you have to make execution, and you know that we made a lot of transaction in the right timing, because today we are in this condition because we made the acquisition at the timing, but the tough work is when you make integration and IT integration of people, culture. So as soon as you start with this process, you will enter into a difficult condition. You will have to dedicate managerial attention. You have to postpone some investments in technology. So Intesa Sanpaolo remains today the only option that can say, okay, we will continue to deliver these results with a sustainable approach and with all the attention of the CEO on delivering results.
Carlo, going back to this, confusion, because there's just there's a lot of news out. The Italian government wants one thing, you have Mediobanca getting involved in Monte Paschi, or the other way around, you have Commerzbank trying to be bought out by UniCredit. What do you think makes sense for the Italian banking?
So that's for sure. You have all the transaction that can have an industrial sense can make sense for the real economy. So if you are in a position to create a player that can improve conditions for clients and for all the stakeholders, you can create value. So it is clear that a transaction like the one that we made with UBI, so the one that you can perform in the banking sector, can make some synergies, mainly cost synergies through reduction of people. So this is a point from a social point of view. And this is something that can create value in the medium-long term. Other kind of transaction are a question mark. Then it is not, I cannot tell you that cannot work by definition, but it will be more difficult to understand what could be the final results.
I know you're very focused on clients and getting new clients. Do you think it's an advantage, staying away from
Absolutely.
All of these moves?
It's an advantage from a client point of view by definition, because client will enter into something that is the difficult position. When you enter into integration, you will have people that have relation with client that will enter into some uncertainty, and this is not positive for an organization. And we are a safe harbor by definition. At the same time, you will have also a lot of talents, because some companies that are involved in this transaction have a lot of high-quality management team. And Intesa Sanpaolo, by definition, is the place in which, if you want to work in private banking, investment banking, not saying nothing that I cannot say, but by definition, if you want to stay in an environment with a leading bank in Europe, with the possibility to have significant career, you can join Intesa Sanpaolo.
So I feel like it's an open pitch.
Absolutely.
So you're getting talent.
But you know that I'm very tough when I want to do something. So I'm ready to have all the talents that are in uncertainty in this period in Italy.
Who needs LinkedIn?
So no acquisition of banks or other entities, but potential acquisition of people. So.
You're open to
yes, that's
hiring
right.
Carlo.
You can join us.
Carlo, thank you so much. Carlo Messina, Managing Director and Chief Executive Officer of Intesa Sanpaolo. Coming up, it's BOE Decision Day. We'll be live.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Was going to keep Rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The Bank of England is expected to cut interest rates for a third time later today, but with a warning that further easing will be gradual. Bloomberg's UK correspondent Lizzie Burden is outside the BOE. So, Lizzie, set up the guide, the decision for today.
Well, here in the UK, we've got an economic situation that's somewhere between the US and the euro area, Francine. You've got weak growth, but also that short-term pickup in inflation. And that's why unanimously economists are expecting this quarter-point cut today. The only dissenter expected is Catherine Mann, the big hawk on the committee. But it would be a dovish surprise for markets if even she voted for a cut today. And maybe we could see a jumbo cut vote from Swati Dhingra, the archdove on the committee. The other signal that markets are watching out for is the Bank of England non-committal on the path ahead? Because the expectation is that actually they don't ditch the guidance and they stick to the guidance that it will be a gradual path from here on out. Now, speaking of the future, the real focus, at least for the Chancellor Rachel Reeves, is going to be the forecast for the path ahead for the economy. The expectation being that they downgrade growth, raise the inflation forecast, but it'll be predicated on an outdated market curve, and so it's a difficult communications job for the Bank of England Governor Andrew Bailey. He's been here before, but if he doesn't kind of push back against market pricing, then it may appear that he's criticising the Chancellor, because it's going to look like the budget in October has added to the problems of the economy, and indeed growth is the Prime Minister's top priority. But the last thing I'll say is this is really important for the Chancellor in terms of her headroom. Of course, she's waiting for that forecast from the Office for Budget Responsibility in terms of how much headroom she has left. But this will give her a bit of a clue as to whether she'll face a difficult choice between spending cuts, more tax rises, or breaking her non-negotiable fiscal rules.
Lizzie, thanks so much. Lizzie Burden there with the very latest on the Bank of England. In the meantime, the French Prime Minister, François Bayrou, survived 2 non-confidence motions yesterday, finally ensuring the adoption of a budget following months of political turmoil. Let's get more with Bloomberg's Caroline Conan. So, Caroline, how did Bayrou manage to survive, and what's actually in the budget?
You know, Francine, the hemicycle of the National Assembly was almost empty yesterday, and that's because neither the Socialists nor the National Rally of Marine Le Pen decided to show up and vote for this motion of no confidence. Instead, they decided to abstain, and that's because François Bayrou, the new Prime Minister, has had quite a different approach from his predecessor, Michel Barnier, whose government collapsed early December. He's included the Socialists from the very early stages in January in all the budget discussions. He's also reopened the Pandora box of the pension reform with new discussion on the retirement age. So clearly, this is a very narrow path for François Bayrou, but he's managed to survive even though there is still a fractured parliament. Already, the last motion of confidence cost 12 billion euros to the French economy. That's according to the government. In this new budget, 50 billion euros of savings. This is, in theory, going to avoid snap elections, at least in the short term.
Caroline, as always, terrific briefing, Caroline Conan there in Paris. A reminder, don't miss our interview with the U.S. Treasury Secretary Scott Bessent at 6 p.m. London time. That's one interview you definitely don't want to miss with David Gura. Up next, the Bloomberg Brief, Manus Krani in New York, and this is Bloomberg.
suppose I want to buy a computer, but I want to have AI in my computer. I want to be really up to date. Do you have AI in your computers yet?
No, not yet, but it's coming soon. And we think this is going to be one of the largest transformations in the PC industry in decades. What will be possible starting this summer is to run large language models in AI PCs, which means that what today all of us are doing in the cloud, where you use any of the applications that you can, you will be able to do it locally. And what this means, which is why we think this is important, is it will be much better from a cost perspective, because running models in the cloud is expensive. It will be better from a security perspective, because you will be able to use the model with your own data locally without having to upload your data to the cloud, and you will be able to do it anywhere in the world. And also for applications where speed is important, where latency is important, you will be able to do it locally much faster. For example, in gaming, where the game needs any resource the computer have, it will be a much better model. So it's going to be a big change starting this summer.
At the same price, too.
Slightly higher price, but if we look at the increase of price versus the increase of value, not comparable.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ. Only on Bloomberg.
Good morning from our global headquarters in New York. I'm Menace Graney. You're welcome to Bloomberg Brief. Let's set that agenda. Chip concerns. Qualcomm falls as stalling smartphone demand as ARM spurs concerns of a slowdown in AI spending. It's yields, not the Fed, that Treasury Secretary Bessent says the administration's focus is on the 10-year Treasury. Decision day for the Bank of England, expected to cut rates and lower its UK growth forecast. Good morning to you. The equity market searched through the wreckage yesterday and decided to lean into the better ADP jobs number over the services numbers. We're up by an 1/8 of 1%. Be wary, though. We have the legendary short seller, Jim Chanos, in the studio yesterday. He said, we are not at the froth of 2021. We'll talk more about the individual stocks in just a moment, but it was a message from the Treasury Secretary which has imbued a sense of confidence in this bond market. Now, yields are up by 2 basis points this morning. I just want to put it in context for you. You have touched the lowest yield of 2025. We dropped by 20 basis points yesterday on the 10s from the highs, as Scott Bessent, the Treasury Secretary, said in his interview with Fox, and he'll be in the studio later today. Trump wants to lower the 10-year yield, not Fed cuts. So the Doge Committee really comes into a sharp focus, and Dan Iverson over at PIMCO says, embrace the volatility. Some stocks we are keeping an eye on. Tech again very much in focus, this time on the chip side. ARM falling after the chip design company provided a tepid outlook, underlining the concerns about the pace of spending in AI, down 3.6%. Ford also on the back foot today, warning that profit may fall by $2 billion or more this year due to lower vehicle prices, costly new model launches, and of course the risk of tariffs from President Trump. SocGen shares jumping after the French lender reported results that helped confirm the recovery in the French retail banking unit. And in just a few moments, Sharon Bell joins me from Goldman Sachs. How optimistic is she as we see records made across Europe? And then later in the hour, Nella Richardson of ADP and Anthony Fobel of Archmont Asset Management. Well, in the absence of new developments on the trade front boosting risk appetite this morning, that's as President Trump delays the imposing of tariffs on Canada and Mexico to early March. Goldman's Sharon Bell weighing in on the big topic with this. We think a further extension is likely, but the tariff risk for both countries is likely to remain until at least the conclusion of the USMCA review, and that's slated for mid-2026. And please say Sharon joins us, Senior European Equity Strategist over at Goldman Sachs. Sharon, good morning. Look, the tariff genie's out of the bottle. So I just want to frame this. How optimistic are you that this is about Trump extracting concessions, or do you think we ultimately end up with that sticker price of 25% on Canada and Mexico?
It's a tricky one, isn't it? I just think uncertainty is going to stay high. And as long as uncertainty is high, it affects investment, it affects sentiment for companies, it affects what businesses want to do. So it's tricky to read exactly what Trump will do, but I just think this uncertainty is still going to weigh on growth and weigh on investor concerns. Will he do the 25% for sure? I mean, clearly not. I mean, he's already paused. So it may happen, it may not, or it may happen to a smaller degree. There may be more concessions, more negotiations, but this just keeps tariffs in the news, I guess.
Look, it's like red headlines every day. My favorite line comes from Julian Emanuel at Evercore. He said, you want to discern the trade war heroes and the trade war weary. Can you just give me a soupçon of what you think the trade war heroes could be?
The heroes as in which stuff could do well in the event of a trade war. Yeah, I mean, I don't think generally economists will always tell you that you don't gain from a trade war. In net terms, most people will be losers. But I guess the areas in terms of asset classes that will gain in a bigger trade war, let's say you have retaliation, that say Trump ups the ante on some of these, the rhetoric that he's had recently. Things like gold, obviously, people going to more safe assets like that. The dollar as well probably rises if trade war risks rise. And then also within the equity space, which is what I look at, more defensive areas gain. So to the extent that we do get a bigger trade war, what we tend to find is more quality areas, more defensive areas tend to outperform rather than more cyclical areas.
Sharon, just hold that thought. We've got a little bit of breaking news coming through on Honeywell, actually. I just want to bring this to our audience. So Honeywell is to break into 3 independent companies. This is according to Wall Street Journal. The headline that they have is Honeywell to break in a bid to recreate some of the GE magic. A little bit more on that reporting. We'll bring that to you. So that's a breaking news headline on Honeywell. Break it up and create value. I think that's the theory, isn't it, Sharon, with these massive breakups and restructures. It's about extracting value. When it comes to the equity market, let's just pivot back to this. The risk from tariffs and a trade war is that you have a growth shock and an inflation pop. And when I think about the equity market calls, those big echelons, 6,500, 6,700, and 7,100 here in the US, that is predicated on a status quo or a Goldilocks kind of growth environment. Has that shifted at all for you?
Yeah, I mean, we call it price for perfection. Goldilocks is another potential name for it. So it's an environment where you have disinflation, certainly inflation's not going up, and you have good economic growth. And you also have good earnings as well from individual companies. And all that mix gives you high valuations and very good returns, and that's exactly what we've had, at least for the last couple of years in the US. Of course, valuations have now gone up quite a lot. They are high, and this is where we say price for perfection. But then again, the US economy kind of so far has delivered that type of perfection. We have had inflation fall, we have had rates come down, we have had good economic growth.
Is perfection challenged in that case, Sharon, if there are no rate cuts? This was a theory in the summer last year, we don't need rate cuts to continue price for perfection, but that narrative is shifting, isn't it?
Yeah, I mean, I feel that you do need some rate cuts this year, or rather, maybe put this another way, you do need to see a continued sign that inflation is coming down, is moderating. If these tariffs, and we still don't know, it's a lot of uncertainty, as said, if these tariffs are imposed in big style and there's retaliation and all of that, then that will be inflationary. So, and the market's still unsure, as we've been discussing about that. So if you've got higher inflation, this, I mean, the Fed might look through it a bit because they might see it as a kind of one-off, one-year rise, but still, I think that will worry people.
Well, the Treasury Secretary was on Fox yesterday afternoon. He'll be in this studio a little bit later on today. Let's just take a listen to what he had to say. He had some big messages. Let's just take a listen.
they did a jumbo rate cut and the 10-year rate went up. Now I've seen this year, despite the growth estimates going up, 10 years coming down, because I believe the bond market is recognizing that, as you and I talked about, energy prices will be lower and we can have non-inflationary growth. We cut the spending, we cut the size of government, we get more efficiency in government, and we're going to go into a good interest rate cycle.
And to be fair, those bonds, those 10-year bonds are down 20 basis points from their high yesterday. For an equity analyst like you, when you hear Scott Bessent doubling down on 3% growth, 3 million barrels a day in terms of liquids or oil equivalent, and a 3% deficit, what does that do to the equity narrative? Because it's leaning much more into the Doge narrative, isn't it?
The idea of you're cutting costs, but you're also expanding oil supply, and that gives you an environment where you can retain this Goldilocks perfect growth scenario, where you can grow but also bring down inflation, etc. There are other things, of course, that he didn't mention, which the US government are looking to do that will be a bit more inflationary, such as the tariffs that we've been talking about, such as also tightening up on migration, because of course that reduces your labour supply and that will be inflationary. So I think it's a bit more of a balance.
Well, let's see what he's got to say today. One thing that caught my eye, there's records abound in Europe. You just look at the earnings upgrade for Europe relative to where we were last year. I mean, the underperformance of Europe last year to the US was significant. That has flipped around. I just wonder, is that a tail trade that moves to the middle of the bell curve?
Yeah, it has been a long time that Europe has been an underperformer. You could probably even count it back to the financial crisis. Since then, most of the time, Europe has underperformed and underperformed really badly in the last few years. And investors have been super skeptical. I mean, when we survey investors, we've done polling at our various conferences earlier in January. Everyone is underpositioned in Europe. Nobody particularly likes Europe, etc. And the valuation discount to the US is very, very big. So maybe this is Europe's time. The only problem is that European growth, economic growth, is still very lackluster. Germany's still really flatlining, etc. So I think there's a valuation there, and there's a lack of positioning in Europe, which maybe means that investors aren't looking in this area for outperformance. But equally, there's also quite weak economic backdrop as well in Europe.
Sharon, thank you very much. Let's see whether that differential endures. Sharon Bell of Goldman Sachs, and don't miss our exclusive interview with the Secretary Bessent. That is at 1 p.m. and that is from the Treasury Department. Well, we're counting down to the Bank of England decision happening in less than 3 hours. Let's get to London. Lizzie Burden is outside the Bank of England. Lizzie, good morning to you. Good afternoon. We are expecting a rate cut, but it's the outlook for the economy that's perhaps going to be a little bit more beefy for us today, isn't it?
You're absolutely right, Manus. Let me just situate the UK for you in the context of what Sharon just said, because we've got a touch of the US issue and a touch of the euro area issue. We've got weak growth, but we've also got a short-term pickup in inflation. So a unanimously expected cut today, but as you say, really a focus on the forecast, and stagflation is what is expected there. I would note that the forecast is based on the market curve, which is presumably out of date by now, and Andrew Bailey is surely going to have to pick up on that in the press conference, or else, unless he pushes back against the market curve, it would seem that he's criticising Chancellor Rachel Reeves, because the expectation is that they're going to downgrade growth and raise the inflation forecast. Stagflation, in short. And it's not a good look for the Chancellor, given that growth is the government's top priority, and it may be that that payroll tax rise in her October budget has added to inflation more than was initially thought. The other reason, Manus, why they'll be watching these forecasts so closely from Downing Street is it'll give an indication of how much headroom Rachel Reeves has left. Of course, that's officially decided by the Office for Budget Responsibility, but it will give us a clue as to whether she's going to have to choose between spending cuts, more tax rises, or breaking those non-negotiable fiscal rules. The other thing is, though, I'm sure that Andrew Bailey's going to be asked about tariffs in the press conference. He loves to talk about how he has a passion for free trade, but our economists reckon because the UK isn't directly expected expected to be hit by tariffs at the moment. There'll be, in any case, a hit to growth. If we are directly hit, then it would also hit inflation, and therefore the Bank of England wouldn't be able to ride to the rescue as much of the UK economy. But it means that the forecasts might already be too rosy because they cannot integrate the impact of policy that hasn't yet been made.
Well, President Trump already a little bit more complimentary about Keir Starmer than he is, perhaps, let's say, about some of his neighbours. So maybe it won't be just as aggressive. Of course, we wait to see for Europe and for the United Kingdom. Lizzie, great work. We'll see you later on through the day. That's Lizzie Burden at the Bank of England. There are other stories trending on your Bloomberg terminal. Let me just bring them to you. And Bloomberg sources say that a consortium proposing to take over Seven & i Private has tapped Citi and Bank of America for financing. Now, their role in the bid would be to refinance the debt and the company's U.S. unit. Representatives for Citigroup and Bank of America did not immediately respond to requests for comment. Chinese retailers that sell on Shein and Temu say that they've been asked to start paying an additional 30% levy on goods imported to the U.S. from China and Hong Kong. This is after President Trump's tariff hike. The vendors received notifications about the new prices they would be charged by the logistics agents. That was late Wednesday night, according to a memo seen by Bloomberg. McKinsey partners have been questioning the consulting giant's presence in China as the tensions with the U.S. rise. They argue that the lucrative North American business can be more than offset at any China retreat. Sources say some senior partners have been voicing their concerns since late last year, even before President Trump was elected.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Qualcomm's on the back foot this morning. The pre-market trade shows the chip maker's latest earnings raise concern about the slowing smartphone demand growth, and the company expects the overall market for smartphones to be flattish in 2025. Peter Elstrom is the executive editor for Global Tech for Bloomberg News. Look, we've had a feast of technology. Now we're in the chip world. When you look at Qualcomm, what are they saying to us about the smartphone market? They've got a big relationship with Apple. What's the top take on this? What's the spook?
Well, Qualcomm did offer this quite cautious outlook, as you say. The smartphone market, of course, went through years of very, very fast growth. More recently, it's been pretty sluggish across the world, where you've seen flat growth, you've seen declining growth in a number of years, too. And Qualcomm is quite a bellwether for that market. They have more insights into what's actually going to get sold there and what's not going to get sold there. So having Qualcomm come out and the CFO said they expect either a flat market or single-digit growth in the market, which is pretty conservative for the smartphone market, because their fate is so closely tied to that smartphone market, that's a pessimistic outlook for them. But more broadly, it raises questions about growth in the smartphone market and the tech industry more broadly.
Look, the tech industry is grappling with what DeepSeek means, with what the Chinese advancement means. If I look at ARM's overall report, you've got Rene Haas really sort of trying to talk up the AI component with, you know, a chip design being sort of slightly tepid on the outlook. How did it balance out there?
Right. Well, ARM is another company that was for many years tied very closely to the smartphone market. They kind of grew with the smartphone market. Now Rene Haas, as you say, has these strategic initiatives to be able to get into a number of different markets. The most important, of course, is AI. He wants to be able to capture some growth in that AI market, perhaps delve into the territory of NVIDIA in particular, capture some of the value that those companies are getting. So far, it seems like the pace of entrance into those markets has been a little bit slower than investors would like. They have both the smartphone market holding them back a little bit, and then in terms of that growth in the AI market, it's been a little bit sluggish. Overall, I'd say the big question for investors this quarter is whether these huge investments that companies are making in AI are going to pay off in the long run. We haven't really seen much of that so far. Investors are still waiting for those positive signs.
Okay, Peter, thank you very much. That was Peter Elstrom on the very latest from the chip world. Coming up on the show, toning down the White House attempts to shift the tone around President's controversial Gaza proposal. Context next on Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today. and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It's Jobs Day, and Bloomberg has the report under surveillance.
Whatever this number looks like, we will build a massive narrative and extrapolate it out 12 months.
Yep, and then we'll remind ourselves that these are very noisy numbers.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
How tight can the labor market get if we do see these deportations?
Companies are waiting to figure out what the policies are.
And lots to think about.
The January Jobs Report, Friday on Bloomberg.
The U.S. will take over the Gaza Strip, and we will do a job with it, too. We'll own it and be responsible for dismantling all of the dangerous unexploded bombs and other weapons on the site.
That was President Trump on Tuesday. Here's what the press secretary, Caroline Levitt, less than 24 hours later had to say.
The president has not committed to putting boots on the ground in Gaza. He has also said that the United States is not going to pay for the rebuilding of Gaza. His administration is going to work with our partners in the region to reconstruct this region. And let me just take a step back here, because this is an out-of-the-box idea. That's who President Trump is. That's why the American people elected him. And his goal is lasting peace in the Middle East for all people in the region.
Now, that was Caroline Levitt, and this is, the nuance is important. We've gone from the president talking about doing what is necessary, long-term ownership, and then in the press briefing yesterday, it was about would the president commit to U.S. troops in Gaza, and this is where the nuance really is important. You've had considerable pushback from Russia, from China, from Germany, and Saudi Arabia, and this is where they're trying to walk back those sort of perhaps overreach statements from the President of the United States. Antonio Guterres, the UN head of the UN, has said that at a meeting on Wednesday, he said it is essential to avoid any form of ethnic cleansing. And again, this is the accusation that is being made as both Bibi Netanyahu and President Trump sat in the Oval Office yesterday. And again, this is trying to understand the scale of desire by President Trump to participate across borders outside the United States of America. We will talk more about that a little bit later in this show. Let me just show you, we are in Bank of England Day. We're waiting for a rate cut from the Bank of England. We're counting down to Jobs Day tomorrow in the United States of America. We've had ARM, we've had Qualcomm, you've had a mammoth amount of technology companies coming with the report. Yesterday it was about the downside for Alphabet, Google, down 7-8%. Let me just show you the cross assets this morning. This is what we've got for you. S&P 500 up 0.2%, and the dollar index up 0.25%. Let's return to our political story. Kevin Whitelaw is standing by for us. Kevin, this step back by Caroline Levitt, this is perhaps trying to undo some of the verbal overreach by President Trump?
Yeah, I mean, you know, this is something we have seen from the president before, particularly in the early days of the first term last time. You know, he gets ideas, he wants to put them out there. They come from, you know, various places. This one may have well come from his son-in-law, Jared Kushner. And then everyone sort of has to scramble and figure out, you know, what it means and what is actually doable. And I think the immediate reaction, particularly the swift reaction from Saudi Arabia, showed that this was really pretty much a non-starter in the region. And so now they're sort of backpedaling to sort of figure out what that actually means. You know, I think the deeper issue is Trump came into office saying that he wasn't going to get the U.S. into more foreign entanglements. And so, you know, that made this Gaza thing look particularly sort of out of step.
Kevin, thank you very much. Kevin Whitelaw.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Manus Cranny. Let's set that agenda. Chip concerns. Qualcomm falls on stalling smartphone demand as ARM spurs concerns of a slowdown in AI spending. It's yields, not the Fed, that Treasury Secretary Scott Bessent says the administration's focus is on the 10-year Treasury. And don't miss our conversation with private credit with Archmont CEO Anthony Fogel. So, stocks this morning, we just had Goldman Sachs, Sharon Bell, saying you are still priced to perfection. There's an uninterrupted view of the upside at the moment. Stocks are higher despite ARM and Qualcomm on the dip this morning. So we searched through the wreckage, the tech wreckage yesterday, and we've managed to balance ourselves out, in part because of the drop in 10-year government bond yields. By the way, roll it over. 10-year notes dropped by 20 basis points from the high yesterday, solidly breaking through this 450 level. You had lighter data on services and new orders, but it really was then, as the day went on, Scott Bessent, the Treasury Secretary, talking about wanting to lower. Trump wants to lower 10-year yields, not Fed cuts. It's about deficit reduction. It's about energy production. And those narratives play into controlling the deficit and getting it down to 3%. How you get there from a debt to GDP ratio of 6.4% is the tougher question. PIMCO are saying you want to embrace the year of volatility, but be respectful of it. Well, the U.S. labor market, we're counting down to the jobs report tomorrow, of course. American companies adding more workers in January than was forecast. This is the private payrolls rising 183,000 last month, according to ADP Research Institute. And pleased to say, to take a closer look at the data and set the table for the jobs report, it is Nella Richardson off. She is the chief economist at ADP. Nella, good morning to you. Can you square for me your data, 183,000, the 6 month is moving quite nicely. Then I look at the services side of the equation yesterday, and that slowed, and I've got jolts dipping as well. Can you just square the circle for me on the outlook?
Good morning. And yes, the headline number is very strong, but there's a lot to square underneath the surface. So let's start with that service number. We saw growth in those industries that were oriented and consumer facing. So that includes leisure and hospitality, over 50,000. And again, trade, transportation, utilities. So think retail trade, warehousing. That was a strong market this time around. But where you saw weakness is in business services, so professional business services, information services, less activity, and then manufacturing actually shedding 13,000 jobs. So it wasn't a holistic strength. We definitely saw weakness. As long as the consumer is resilient, the consumer is guiding hiring in the labor market right now.
Is it too soon to say that the blue-collar pressure that we saw last year is morphing into a white-collar problem? Is it too soon to call that deceleration?
I don't think so. If you look at jobless claims, yes, they are at a historical low, initial jobless claims as a proxy for layoffs, and have been so for about 2 years now. But when you look at continuing claims, people who are still receiving jobless claims, it looks like it's taking longer to get a job. This is what we picked up also in the ADP payroll data, that it is taking college degree holders a bit longer to get a job than it did 2 years ago. Remember, in the Great Resignation, jobs were aplenty. We're not seeing job listings in the JOLTS data for these professional business services grow. So there is some weakness in white-collar jobs, and we should continue to track that.
We're at the foothills, as I would say this week, of understanding what tariff risk is and what trade wars could be. When you look back at the previous Trump administration, to what extent did that overlay impact the hiring freeze, hiring delay? What can we learn from Trump 1 that we can perhaps apply to the jobs market in Trump 2?
Right. We really didn't see the slowdown in manufacturing hiring until the last 6 months of 2019. So what we're seeing now, I think, picks up of that pre-pandemic trend. The pandemic period was almost like a hiatus from a general weakness in manufacturing. So in terms of what to look forward to, not necessarily look forward to, but what we're looking for is whether or not those tariffs hit input prices for manufacturers, or whether they're placed on final goods, because that's going to matter a lot in terms of how the industry absorbs any kind of tariffs. And also for exporters, what that means for their business when you combine tariffs with a stronger dollar, does that affect hiring for manufacturers that export abroad?
Now, some of the more extreme modeling around the risk from tariffs is a 1.7% drop in GDP and a 0.7% add to PCE. If we move towards the more extreme of those scenarios, how quickly would that unravel in terms of an unemployment rate that moves towards the 4.5% that the Fed is obviously focused on than where we are now?
If you're looking, Manus, at that extreme scenario, I think that would incorporate retaliatory actions on the part of other trading partners. And in that sense, if we're seeing some sort of global slowdown because of geographical fragmentation that hits the supply chain and reduces trade, yeah, that would be not just a U.S. issue, that would be a global issue, and it would feed back into hiring. But that is an extreme scenario in my view. If you're looking for a more moderate approach to tariffs, what we saw in the first administration, I think companies could navigate a more lenient tariff structure. So we're still looking at scenarios right now. We're early innings in this trade policy, and we'll have to see where it all lands. But we'll be looking at the hiring data, particularly in manufacturing, to see what the effect is on the labor market.
So that sounds as if it's ground zero, even though the services number was lighter for you yesterday. We had Mr. Barkin here yesterday, and he talked about big cap does the CapEx spending. Small businesses do the bulk of the hiring in the U.S. economy. Is it too soon to see any restraint in small businesses, or how much of a risk is it on the radar for small businesses on hiring with perhaps no rate cuts and the risk of moderate tariffs?
Small businesses are the most vulnerable, in my view, to an interest rates that are paused, because they're getting most of their lending, their financing from banks in order to extend those businesses. They're not able to access the capital markets, and so they don't have the same flexibility. And we have seen weakness in small businesses leading up to a fairly strong January. Small businesses are also over-indexed into consumer-facing industries. So if you couch slightly higher interest rates or interest rates staying where they are now with a consumer who pulls back, then that's a double whammy for small businesses. So right now, looking at the early part of 2025, we were heartened by the 39,000 we saw for firms under 50, but we're going to watch that number very closely to see if they can manage all these risks in the economy in 2025.
Tell me this, how much more time now are you spending, how much more intellectual time are you spending on AI going beyond just large language models? I look at the ARM results last night from Rene Haas, and he's talking about rising AI adoption emerging in smaller, lighter language models. So it's not just about the huge, beasts of AI. It's about the transmission to the real economy now, isn't it?
It is, and you asked how much time, I spend a lot of time thinking about AI and how it affects the workforce. We look at jobs, yes, we're talking, Manus, today about jobs, but I think in the future we'll be talking about skills and tasks and what AI and advanced technologies in this bucket will do to our roles. It's not necessarily affecting job creation, but it is affecting task creation and the skills needed to drive the economy forward. So it has a big impact on the worker and the workforce in terms of productivity gains. So we're looking at how do these technologies advance productivity and how does it make the labor force more productive, not necessarily in the numbers this month, but over the long term.
Okay. Netta, thank you very much. Netta Richardson, counting down to the jobs report tomorrow on the back of the ADP. Well, Honeywell shares, as we said earlier, breaking news for you. Reports are that they plan to split into 3 independent firms. The Wall Street Journal says the announcement could come today. Bloomberg opening trade co-anchor Guy Johnson joins me for more. Guy, I love the Journal's headline. Honeywell to break up in a bid to recreate the GE magic. What do we know? What would a breakup look like? And would it be magic? Good morning.
Well, it might be magic. The GE story has been magic, Manus. You take a look at what GE has delivered. Larry Culp has absolutely smashed it. So that company is now worth 4 times what it was pre the breakup. Remember, GE split into 3 divisions, and as a result of which, you've now seen this model potentially now being applied to other businesses. So Vimal Kapoor, the guy that runs Honeywell, he's been talking about this for a year. He's been pushed around by Elliott a little bit to do some sort of a breakup. We've been reporting on this as well. This shouldn't come as a massive surprise. I know that the Journal headline seems to have come out of nowhere, but I promise you it really hasn't. This has been coming for a while. Larry Culp has done such a good job at GE and has created so much value that wasn't there before. There was such an epic discount being applied to that conglomerate that it has to be repeated elsewhere. And Honeywell is one of the most obvious cases in point. So it looks like they're going to split up. 2-3 divisions look like it's going to be likely. You're going to have a materials division, you're going to have the aerospace division, and you're going to have the automotive division. The expectation will be that it is going to be worth significantly more. Now, it's interesting to see the share price has risen this morning, but only by around 4%. If you apply the GE maths to Honeywell, potentially that share price could go significantly higher. And it'll be interesting to see how the market kind of parse the maths and figure out exactly what this all is going to be valued at going forward from here. But this feels like it's early days. It's going to be really interesting to see how this works its way through. But certainly the GE model, there's some logic to applying it to Honeywell. That certainly seems to be the view of the market and management.
I get the sense, if you look at what Elliott said there's an abundance of evidence that simplification of results in better business performance. So that is their narrative. But you look at how long it took GE to get to the end point, and that was really quite a long period of time. I get the sense this will, the sense from this reporting is that this will be shorter and sharper in its execution. As you say, the CEO's been talking about it for a year. How fast do you think that we'll see this transition to the party of 3?
It's a complicated process. It's not something that you can simply do overnight. There's all kinds of back office operations, pensions, all kinds of other things, Manus, that need to be split apart. Where does the debt go? It is not something that you can do easily. GE took its time, got it right, and delivered the right outcome for its investors. And I think maybe that is the model. You want to get this right. Now, whether or not there has been some pre-positioning being done as a result of, as you say, this year-long process, I don't know. But this is not going to be something that happens overnight. Conglomerates are complicated businesses. They could take a while to unwind, and Honeywell maybe no different.
Guy, thanks for jumping on the story there. It's Guy Johnston, Bloomberg Open Trade co-anchor there, joining us on the very latest breaking news. Other stories trending on your Bloomberg terminal. This is what we got for you this morning. Shares of Qualcomm, they're falling after investor fears of slow smartphone growth in the coming year. The company expects the overall market to be flat or increase low single digits in 2025. The forecast fell short of analyst estimates, despite a 17% increase in revenue to $11.7 billion in the fiscal first quarter. Treasury Secretary Scott Bessent said the President Trump wasn't concerned with the Federal Reserve cutting interest rates. Instead, the administration is focused on bringing down borrowing costs. The specific focus, the 10-year Treasury yield. Bessent also repeated his view that expanding energy supply will help lower inflation. Around 40,000 federal employees have taken up the offer from the Trump administration. They will be paid until the end of September if they agree to leave. An official from the Office of Personnel Management familiar with the deferred retirement data told Bloomberg that the number was growing. The deadline, I should say, to apply for the scheme is the end of today, Washington time. Coming up, Anthony Phobel of Oakmont CEO explains to us how he navigates the uncertainty of President Trump's second term in private markets, right here on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of the regulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bloomberg Brief, I'm Manus Cranny in New York. Now to the world of private debt. Our next guest writes that there is no certainty in terms of Trump. Nevertheless, we are actively incorporating our views on this developing topic, particularly in constructing an appropriate downside case when evaluating any investment. Anthony Phobel is the CEO and the founder of Oakmont Asset Management. Oakmont has 31 billion euros of assets under management. Anthony, good morning to you. Great to have you with us.
Good morning.
You have perhaps the greatest base of businesses that have exposures around the world. How are you modeling your current portfolio of companies to the risk of Trump tariffs?
Sure, and not surprisingly, it is something we're looking at very actively. At Arcmont, we are very much focused on mid-market European businesses. So one of the analyses we carried out was to see what exposure we have directly to trade with the US. And perhaps not surprisingly, given the focus of our businesses, it tends to be much more national or European focused. So we don't think we have any material direct exposure. I should also add the nature of the businesses we focus on tend to be quite defensive businesses anyway. So in sectors like IT services, healthcare, education, again, with limited direct exposure. I think the thing that's more difficult to ascertain is what the the indirect implications of Trump tariffs might be in terms of a general European slowdown. And obviously that's a question that many commentators are contemplating at the moment.
Well, there's the point. It's about a growth shock, either here in the United States of America or indeed in the targets of tariffs, and we've yet to understand what he will do in Europe. In the event of a growth shock, how do you see financial conditions? Typically, they will tighten, but then you presumably have a scale of dry powder that you're ready to deploy. You probably would quite see the opportunity in a growth slowdown for you at some level.
Yes, we think about our businesses in two halves, as you say, Manna. So the first half is obviously our portfolio, which, given that we're making long-term loans, we do sensitize that for reasonable downward shocks. And we think the portfolio would remain pretty robust. Certainly, if you look at the slowdown we saw in Europe during the acute period of the Ukraine war, where we saw very high inflation, very high energy costs, and so on, actually the portfolio proved to be very robust. If we would have a very severe downturn, then obviously that would have implications, and I would argue probably in those circumstances, being in senior debt is probably quite a safe place to be. The second part of our business is obviously new investing, and as we saw recently with the slowdown in Europe, actually that creates tremendous opportunities for us, because typically in that environment we see banks retrenching aggressively. You know, we saw the liquid markets close to new issuance in Europe for 2 years, which is pretty unprecedented. And given that we have long-term capital, that creates great opportunities for us to invest when other people don't have capital.
Give me your perception at the moment. You're going to have a majority European companies. They may well have exposure to China. I'm just wondering, the sales processes that everybody was so buoyed up about, the exits, the sales, do you think that you're going to run into a headwind and delays on those exits? Will they be delayed, interrupted, denied?
Well, I think actually going back to what I said previously, we tend to focus more on kind of services type businesses, healthcare, education, software businesses, less on heavy industrial businesses. And that's a very deliberate choice on our part, because we do see, for example, as you correctly say, exposure of heavy industrial businesses to China as potentially being quite risky and quite cyclical. So in that regard, I think our portfolio is certainly quite defensive.
How much do you see Europe relative to the US on the back foot when it comes to deregulation? We're talking about Scott Bessent, the Treasury Secretary here. We'll talk to him later. Do you get the feeling that you're going to go into a period of more aggressive deregulation in Europe, or is that just a hope and an aspiration relative to the US?
I think at the moment it's probably a hope and an aspiration. I think again, we'll need to see how the deregulation shapes out in the US. But I certainly wouldn't say Europe is on an aggressive deregulatory trajectory at the moment. I know, for example, in the UK, there's a lot of talk about deregulating the markets and freeing up those capital markets to attract capital from the US. But again, we're still waiting to see what governments and regulatory bodies are actually able to deliver.
Well, there's a distance between rhetoric and delivery. You were with Danny and I last summer. You're quite bullish on the M&A market. Look, we're running into these temporary headwinds, some people say, tactical trade wars. Do you still have that same optimism on the M&A business?
Yes, very much so. I mean, interestingly, last year, which was a relatively quiet year for M&A, Arcmont had a record year of deployment. It was our all-time greatest year of deployment. And part of the reason is a lot of private credit managers are very focused on the private equity market, and private equity firms, having sat on dry powder for 2 to 3 years, are coming back to the market quite aggressively. And that is driven really by two things. Firstly, valuations have improved, so they can exit businesses at better valuations and buy businesses, but also credit is beginning to flow and at slightly lower rates. So we are forecasting a very strong year in deployment for 2025. And I should add, we're also expecting to see prices and terms remaining pretty good. We're in a higher for longer base rate environment in Europe and elsewhere. And that will obviously increase returns to our investors, I think making the market extremely attractive.
Anthony, we wish you well with 2025. Come back and speak to us when the deals flow change. That is Anthony Faubel there of Arcmont Asset Management on Bloomberg.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Your day ahead looks a little bit like this. Honeywell, Hershey, and Eli Lilly all reporting. You've had that breaking news on Honeywell in the past hour. Bank of England is also going to be a critical focus for us. That is at 7 a.m. Eastern, followed by Governor Bailey's news conference at 7:30. And we have Amazon, the earnings coming in after the market close. A real ruckus in terms of some of the movement of goods between here and China. I'll leave you with a snapshot of what's going on in the UK on the assets. We're expecting the third rate cut down to 4.5%. The talk is stagflation. You've got the pound at 124. FTSE is at a record high, so stocks are at a record high. You're expecting a downgrade to growth to 1% from 1.5%. And 10-year bonds at 4.42. Lizzie Burden will take you through that, and the surveillance team will take you through the next 3 hours.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, you know, with lots of supporters, a really mind-blowing level of innovation against emissions. And, you know, in the last 9 years, that's gone better than I would have expected. So only now could you even, you know, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up very like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Lots of uncertainty. It's the risk-off trade. No one wants to lever up.
Right now, it is business as usual, but maybe a little bit of a bird on the shoulder of uncertainty.
The volatility is not just in the equity market. Now it's cross-asset.
You're going to get an environment that is attractive for investment.
There are areas where you can look at the valuations and go, you know, this is completely reasonable, but it is definitely more of a nimbleness, and you have to be watching things much more closely.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday on a two-day winning streak on the S&P 500 and looking to make it day three. On the S&P, we're positive by 0.1%. On the Nasdaq 100, we're up by a similar amount. On the Russell 2000, up by 0.25%. Your day ahead looks like this, a focus on both the data and the earnings as well. At 8:30 Eastern Time, we get jobless claims. Then later on, after the closing bell, we hear from Amazon. Amazon earnings coming up after the close. Before we get there, music to Bramo's ears from the Treasury Secretary, Scott Bessent, that me and the President of the United States are focused on, guess what? The 10-year Treasury yield.
I told you this is going to be the most important thing of this entire year, and look at that. Scott Bessent, you heard me. I'm with you. I think we all agree that that is going to be the most important metric. The interesting aspect is it takes the pressure off the Fed to cut rates in the near term. He did, of course, go after the Fed on some level, saying, well, they were the ones that messed up in the first place by cutting 50 basis points, and that led the 10-year to rise. But it highlights how they are concerned about inflation and they're concerned about borrowing costs and how that's going to inform their decisions more than any kind of political interference.
This is an argument we've heard before. We've heard it before on Wall Street, that the reduction of interest rates from September through to the end of the year, 100 basis points, actually contributed to the high yields at the back end because there was a worry, a concern that maybe the Fed would be allowing this economy to run a little bit too hot.
He leaned into that idea. At the same time, on the flip side, how much does this affect his decision or not to lengthen the duration of some of the deficit, given the fact that we had the announcement yesterday of the Treasury refunding, and it didn't include lengthening the duration like Scott Bessent said that he previously would? How much is that going to be a limiting feature to some of their plans, just simply because they are very cognizant of what we all are, which is auctions and the 10-year Treasury yield?
So two-part story to that. How are they going to manage the average maturity over at the Treasury? One. The second point, I think, is an important one. Will they be constrained by this bond market as they start to develop just how big they want these tax cuts plans to be?
Well, that's the problem. Trump 2.0, everyone is saying, is going to mean higher yields because you have a ballooning reconciliation bill. Potentially, we're waiting on whether that's going to be one path or two. And also, on top of that, the fact that whether or not it's pervasive or one-time hit, many economists will tell you tariffs are inflationary.
When you step back, it puts these two ideas against each other. The idea of more nationalist putting tariffs on types of policies that typically aren't as good for growth with the pro-growth aspects. And you think about the 10-year Treasury yield, and if that is their metric, do they like the fact that tariffs are being treated as maybe disinflationary? And down the line might be a damper on growth, even the uncertainty. At what point is the damper on growth a problem, even though you're getting the lower yields on the long end that some of these officials want?
I think we've all got some follow-up questions. The good news, you get round two of Scott Bessent a little bit later on, right here on Bloomberg TV and on Bloomberg Radio, sitting down with our print reporter, Saleha Mohsin. Look out for that later on this afternoon. That is going to be must-watch. Equity futures right now on the S&P 500, just about positive. The arrowhead looks like this on Bloomberg Surveillance. We'll catch up with Anwiti Bahaguna of Northern Trust with stocks on a two-day winning streak. Ed Mills of Raymond James with Bessent focused on 10-year Treasury yields, and Scott Devitt of Wedbush previewing earnings from Amazon. We begin this hour with stocks looking for a third straight day of gains as traders look ahead to a busy stretch of earnings. And Anwiti Bahaguna of Northern Trust expecting volatility ahead, writing political uncertainty is likely to remain high during the first few months of the new administration. We think investors should maintain a flexible investment strategy that can adapt to changing trade policies. And Anwiti joins us now for more. And Anwiti, good morning. Based on that, you've been busy. How busy have you been?
It's been a little hectic, yes.
Have you had to become super tactical?
Actually, quite the reverse, John. We really, over the weekend, published our capital market assumptions, which focuses on our 10-year outlook for asset classes. And, you know, situation for equities looked decent. It's quite contrast then that Sunday night we were focused so much on what it means for the next day while we are publishing our 10-year view. And yeah, we have to be super vigilant to what's happening every other day now in terms of are we on or are we not. And any kind of positioning you have, one morning you look great because you were defensing on Sunday night, and then in the afternoon of the day when those tariff issues are no longer relevant, then your positioning
and it could change again in 5 minutes' time. I'm just picking up on the line that you wrote. We think investors should maintain a flexible investment strategy that can adapt to changing trade policies. What does that mean?
Yes. So what that means is that in the near term, so 3 to 6 months, while all these negotiations are underway, we expect volatility to be high. But if you look at the fundamentals of the economy, we're expecting pretty decent economic growth this year, around 2.5% or so. Inflation is the big question mark, and keep focusing on that. And company earnings first quarter so far coming out quite fantastic, really, I would say 9 to 10%. And for the full year, expected to be even more than that. So keep focusing on that. The rest is noise. We won't have clarity on that for a while. That clarity may appear sometime in the middle of the year. And if at that point, we know what that looks like, because there are several outcome nodes for all these policies, then reassess, be flexible. Flexible also when the market overreacts to some of the near-term noise. Reposition yourself if there are opportunities at that time.
I love this. People talk about what's going on in Washington, D.C. Noise, It's just really confusing right now. Black box, how could we say anything? It's basically how many times can we say, how many different ways can we say, we have no clue, don't make us comment on it. I am wondering about the uncertainty that we're seeing, even in the narrative around earnings, though. We saw some of the CapEx plans, in particular from Alphabet, and they were punished, even though it was a capacity issue that constrained their sales of some of their cloud computing offerings. I'm just wondering whether this narrative in the market of shifting away from some of the big tech drivers and the CapEx that really went into cloud computing and some of the AI adoption and the broadening out, whether you believe in that narrative having staying power or whether you think that the flipping and the flopping of that is noise.
Yeah, that's a great point, Lisa. We believe in the broadening of earnings this year. And we saw some of that actually in third quarter of last year also. But if you look back for the full year, it was still an AI concentration in tech, that kind of market behavior where everything else was participating, but not to quite the extent that the tech sector was. This year is likely to be noisy, likely to be volatile. Even before the tariff news, there was question mark around, the deep seek news. Our contention is, aside from flexibility, which Jonathan mentioned, another thing to do in the portfolios is to be diversified, to go away from just the tech-focused names and focus on companies with really great balance sheets, with good earnings potential, companies that have so far been sort of ignored by the market, but are really solid companies, such as companies which have quantitatively a low volatility score and a quality score.
Is it still the U.S. that's the focus, or does diversification increasingly mean outside of the U.S. at a time where we heard that in January, everyone was saying, all right, let's think about how low the bar is in Europe, and then Europe gained 8%, and then people are saying, wait a second, maybe let's come back here because tariffs are going back on. I mean, how much do you lean into the ex-U.S. story?
We're still saying Buy America. Even our 10-year outlook has a higher number for U.S. returns than international developed, mainly because of the structure of the earnings component in all these economies. The earnings story for U.S. remains very strong. The buyback story remains very strong. And there are these structural issues in the rest of the world where, as opposed to the buyback story that we see in the U.S., we actually see dilution elsewhere in the markets. And that keeps us U.S. focused.
When it comes to the U.S., though, right now, all the bad news is being priced in, or the uncertainty about tariffs, and some of the good news when it comes to the tax cuts. But we don't have tax cuts just yet, but we do have an extra 10% put on Chinese goods. If you get no tax cuts at the end of the year, do you still want to be invested solely in the United States?
Absolutely. I think the consumer is super strong. The companies are doing very well. So the tax cut is not the only driver. It's not even cut, Anne-Marie. It's the fact that they won't go up. That still remains the driving factor in the market, that we're not really waiting for additional cuts, but the threat of increased corporate taxes is off the table.
We've had some heat come out of the US story over the past few days. You saw that in the ISM services yesterday. Prices paid a little bit lower. The overall headline read came in a little bit lower. We saw it with job openings as well, falling back just a little bit. Nothing to get too concerned about here. I'm not going to say that the Federal Reserve needs to come out and cut interest rates before the next meeting. There's nothing bad out there at the moment. But to Anwiti's point, there's nothing out there to suggest at the moment, based on the data that we've seen more recently, that they need to hike anytime soon.
Which is the reason why you saw a huge rally into duration yesterday, and why you are seeing that rally in the bond market globally that's really feeding into that broadening out story and this idea that this is a positive disinflation, not necessarily something that's coming with cratering growth.
Speaking of the global story, did you see the headline coming from McKinsey?
Yes.
Being global is a choice. Frankly, it is more difficult now to make that choice. I know this is difficult and may become increasingly so. Speaking directly about China.
Maybe they are going to pull out of China. This is what we were talking about yesterday. How long before companies start signaling that the uncertainty is just too difficult? And frankly, it was a money-losing business for them, right? So it's not like they have that much on the line, but the head of McKinsey has wanted to be a global company. Is the idea of being a global company losing some of its flair because of some of the liabilities associated with being with places where the policies are changing so quickly?
The question is it worth the risk? And right now, you have to look at the long term. Is it worth the risk being in China? Jameson Greer will have his hearing today. And last time we heard from him on Capitol Hill, he talked about decoupling the United States from China.
This, by the way, works both ways. If you're Shein and Temu, you're probably thinking the same thing about having a presence in the United States at the moment, based on the headlines we've seen over the past few days. Plenty more still to come on the program on the tension between the United States and China and what it means ultimately for your investments. Right now, equity futures just about positive by 0.1% on the S&P. With an update on stories elsewhere, let's cross over to Yahara Hekes for more. Hey, Yahara.
Hi, John. U.S. Treasury Secretary Scott Bessent says in order to lower borrowing costs, the administration's focus is on bringing down 10-year Treasury yields, not the Fed's benchmark rate. In an interview last night, Bessent said Trump is not calling for the Fed to lower rates. Bloomberg's Celia Mosin will have an interview with Secretary Bessent today at 1 p.m. Eastern. Google is the latest company announcing changes to its diversity hiring plans. According to an internal memo, it said it's reviewing its programs and would no longer have, quote, aspirational goals tied to representation. It joins Meta and Amazon in big tech's retreat from DEI initiatives, which have been rejected by President Trump's administration. Tesla sales in Germany plummeted 59% last month. Only 1,277 new cars were registered. It hasn't seen those levels since July 2021. Musk's intervention in Germany's upcoming election was likely a factor, with a poll taken last month showing he was viewed unfavorably and his political interventions were unwelcome. That's your Bloomberg Brief. John?
Yahara, thank you. We'll see more from Yahara in about 30 minutes' time. A special thank you, of course, to Anwiti Bahagan of Northern Trust as well. Anwiti, thank you. Next on the program, Trump focused on bond yields and not the Fed.
He wants lower rates. He is not calling for the Fed to lower rates. He and I are focused on the 10-year Treasury and what is the yield of that.
Ed Mills of Raymond James joins us next on the program, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bond yield's a little bit higher right now by 2 basis points on a 10-year, 4.44. The next stop for this market, jobless claims later on this morning. The SMNR survey, 213. The previous week, 207. The number drops at 8:30 Eastern Time. Under surveillance this morning, Trump is focused on bond yields and not the Fed.
He wants lower rates. He is not calling for the Fed to lower rates. If we get this tax bill done, if we get energy down, then rates will take care of themselves and the dollar will take care of itself. He and I are focused on the 10-year Treasury and what is the yield of that. I believe the bond market is recognizing that, as you and I talked about, energy prices will be lower and we can have non-inflationary growth
So here's the latest this morning. Treasury Secretary Scott Bessent making clear that President Trump will not pressure the Federal Reserve to lower interest rates, saying the administration's focus instead is on bringing down the 10-year Treasury yield. Joining us now is Ed Mills of Raymond James. Now, Ed, welcome to the program. I wonder what consequences this might have, if any, for the tax cut talks over the next few months.
Yeah, John, there's a lot to talk about here because, the first thought I have is as soon as the Treasury Secretary says Donald Trump is not focused on the Fed lowering rates, we're almost near guaranteed getting a headline from Donald Trump saying the Fed needs to lower the front end of the rates. I do think that when I hear these comments, it is going to be difficult to do as much of the tax cuts as Republicans want to do. Another thing in that interview, Treasury Secretary Bessent said that they should do a score that would allow Republicans to make the tax cuts permanent, extending out current baseline. If we are going to see a $4 or $5 trillion plus increase in the debt and the deficit over the next 10 years, that's more than what the bond market's been looking for. And finally, I guess the thing I would highlight here is that in Trump 1.0, everyone was focused on the equity market, and that was the barometer of Trump's success. Increasingly, clients at Raymond James have been asking me, is the bond market the new barometer? And last night, Treasury Secretary Bessent kind of made that official that we're going to be watching the 10-year to see how successful Trump policies are going to be.
And Ed, isn't that because the bond market has a seat at the table when it comes to what you're discussing, this huge tax bill and whether or not they can go as far as they'd like to go?
Yeah, and when I've talked to folks in and around kind of the Trump administration, one of the things that they want to highlight is tax cuts are only one part of the story. They want to talk about the deregulatory agenda. They want to talk about DOGE. They want to talk about the amount of money that's going to be collected, Anne-Marie, from all of the tariffs that are going into place. And so if you want to get what the Treasury Secretary is describing, I think the market has to be prepared that there's going to be other sources of tax revenue that's coming in and other cuts to the federal government spending. And so the aggressiveness that we are seeing right now by Elon Musk and DOGE is part and parcel giving political cover for the Hill to go a little bit further or a lot further than they thought they might be able to do.
Well, let's discuss how they're going to do that. Senators will sit down with Trump this weekend, and they're talking about this two-path bill. I caught up with Congressman Jason Smith yesterday, who still wants this one big, beautiful bill. But, Ed, that seems to be collapsing in real time. What's your take on the next steps for the Republicans in Congress?
Well, next steps, Anne-Marie, is getting a budget. You can't start the budget reconciliation process. You have nothing to reconcile until you pass the budget. And so this is where the fact that Republicans have as slim as possible of a majority. You lose one vote, you can't get this done. So Donald Trump is also going to be having a conversation later today with House Republicans. He's going to see if he can get them to pass something to start the process. They're still fighting over process. Until you figure out the process, you can't get a bill. I absolutely still think we're going to get the tax bill done. It could be permanent. They could add tax cuts to this if they use the score that they're talking about. But until there is leadership from the White House to instruct them on what to do, we don't know what we get from the Hill until that point.
Ed, I loved how he started this conversation about how important the 10-year is and how this might be the ultimate check on the market. I thought that the photograph that we showed really set it up perfectly, where you have Donald Trump in the middle and you have Scott Bessent on one side, bond representative, and then you have Howard Lutnick on the other side, who in some ways is stock representative, growth representative, trying to get some of these other things across. Who has the louder voice, the louder influence over the man in the middle, Donald Trump, at a time where there are a lot of competing egos, a lot of competing wishes, and it's not clear just how constrained some of those people are going to be by, say, the 10-year yield?
Yeah, Lisa, I guess my flippant answer to that would be the last person who spoke to him. That's what we have seen countless times in this. He has once again instilled what we'd call a team of rivals. And we've seen this in elsewhere, too, on trade, on tariffs. There is a huge match between Team Econ, which is Scott Bessent's world, versus Team Tariff. That is Lutnick. That's going to be Jamison Greer, as mentioned. He's having his hearing today for U.S. Trade Representative. That's Peter Navarro. So what I've been instructed to do when I'm listening to all these competing voices is find areas of commonality. and that's going to be the likely policy. And one of the things that I think the market has been missing is the most dovish view coming out of that kind of team of rivals on tariffs is only starting at 2.5% of a universal tariff and getting to somewhere to 10 to 20%. If that's the dovish view, I want to know what the hawkish view is.
At that point, Ed, how do you advise clients? How do you advise companies that want to make plans, want to understand what their footprint should look like, want to understand where they can expand in the world? Are you telling them to just hold off and that, frankly, they will not know just what that hawkish view is and how high it could go?
Yeah, I'm not telling them to hold off, but I am telling them to expect volatility. I was at a conference yesterday down at our headquarters in St. Pete at Raymond James talking about how volatility is back and that you have to kind of not react to everything to get some of the big conversation right. And so there are a number of things out of this administration that could be viewed as market positive. There are other things that could be viewed as market negative. The way in which they implement that, the timing and the degree, all are going to be the big conversations of 2025, but don't stay paralyzed because if we stay paralyzed, you miss out on a lot of opportunity. Been doing this job for a while. I can always tell you the risk, but that has not been the right strategy before, and I don't think it's the right strategy now, Lisa.
Sequencing matters, Ed. I think we've all been saying that over the last several months. We wanted to know what would come first. We found out the focus was on trade and pretty quickly. For this market at the moment, I wonder how quickly things could change again when we really start to see what's going to happen with the tax package. When do we start to get a better idea of the contours of that? Is it going to take weeks, months? How long?
I think we'll get some idea within the next couple of weeks. As I mentioned, you have to pass the budget first. And Republicans, if we can get a budget in the February, March time period, people will get optimistic on what can get done. And then I want to see what score they're using. It's a technical thing, but if they use a score that says extend out current policy, which is what the Treasury Secretary is expecting to say, that's where we have the conversation about these tax cuts being permanent. That's not priced into the market. If we are in March and April talking about permanent tax cuts as a high probability event, that's a market positive from where I sit. It might have an impact on the 10-year that the Treasury Secretary does not want, and that might be the binding constraint. But I do expect that we will have moments of clarity followed by everything falling apart before it ultimately gets done. And one thing I say about DC is that things appear impossible right up until the moment they're inevitable. But I do think it is inevitable this year we will get something done on tax cuts.
Ed, this was brilliant. Looking forward to being on the journey with you. Ed Mills there of Raymond James on a path forward for the year ahead and the next 4 years. I remember a quote that came from Marko Klanovic, formerly of JP Morgan, who made the case that the biggest challenge for the incoming Treasury Secretary, now Secretary Scott Bessent, wouldn't be enacting change. It would be managing the volatility and the market reaction that might undermine those changes. So when we think about Treasury, you said this yesterday, the complaints about what Treasury Secretary Janet Yellen did with the activist Treasury issuance at the front end of the curve, Rabini's and Miran's words, not my own. And then what do we see from them? A reluctance to term out the debt. And based on those comments that we heard from Scott Bessent, I'd love to know if there's still that reluctance to term out the debt or whether those complaints stick, those complaints to Secretary Yellen. Do they hold? And do they want to make a change?
Clearly, they didn't want to make a change that quickly. So clearly, the actions speak louder than the words. The words, we're already getting some sense of what the words will be like. We have to study it. We want to make sure we do it in a prudent way. We want to have a time. We're just in the door. We've only had 19 days. Come on. Why are you pushing us? The reality is, it clearly is their focus, and that definitely is going to be a constraining factor.
If you want lower 10-year yields, terming out the debt probably won't help. Pushing out the supply further along the curve, just logically, probably won't help.
Which is the reason why I am skeptical of that happening in the near term. However, if inflation comes down and there is some sort of disinflationary shock, and maybe that's the sort of bad angel that comes out and is like, we're putting on 40% tariffs. If you get a tanking 10-year, maybe they term out the debt in that moment.
Up next on the programme, we'll carry you down to the earnings later on after the closing bell. Scott Devitt of Wedbush looking ahead to numbers from Amazon. That comes a little bit later. If you're just joining us, welcome to the programme. Equity futures on the S&P just about positive by 0.1% in the bond market. Bond yields higher. Good morning, Mr. President. The 10-year, 444. Bramo, it's your world.
I feel so seen.
They're coming around, aren't they?
Yeah, absolutely.
This is Bloomberg.
invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Equities on the S&P 500 just about positive by 0.05%. Looking for a 3-day winning streak on the S&P. On the Nasdaq right now, negative by 0.1%. Shook off some of the tech jitters in yesterday's session more broadly. Not a great day for the likes of Alphabet through most of yesterday's session. But for Amazon, Amazon's up next after the closing bell. Look out for cloud revenue. We'll talk about that a little bit more in just a moment. Turning to the bond market, 2-year, 10-year and 30-year. The big takeaway of the data of the past few weeks, taking out just a little bit of heat from the economic story in America. Things still okay, but just not as hot based on the ISM that we saw yesterday and the job openings number we saw before that. Bond yields a little bit higher here, Bramo, by 2 basis points. The 10-year, 443.62.
I have to give you a victory lap. Yesterday, you said to me the most important data point of the day. You said not ADP, and you were right. You said it was going to be ISM services, and indeed, it was ISM services, but it wasn't necessarily even the headline number that came in softer. It was the fact that prices paid, that component came in weaker, softer than people expected. It all speaks to the idea that inflation, nah, it's not going to happen, and increasingly, you've taken the risk of a possible rate hike off the table and really increase the risk of possible rate cuts.
I'll take credit when I deserve it. I'm not sure that comment deserved that much
You
credit.
get full credit.
I don't think it required that much foresight.
It was...
The ISM might be more important than ADP, but okay.
I think
I'll run with it.
prescient.
You're being kind. I like it. I'll accept the compliment. Thank you. Let's turn to foreign exchange. I want to focus on sterling. 30 minutes away, there's a Bank of England rate decision. And Governor Bailey might have to do something that no central banker wants to do anywhere on the planet. Downgrade the outlook for growth and upgrade the outlook for inflation. That ain't good. Sterling's down to 124.27.
The interesting thing is, 3 weeks ago, when you saw the highest 10-year gilt yields going back to 1998, people were speculating that they wouldn't have the room to still cut rates with that type of outlook, with a higher inflation outlook and a lower growth outlook. Now everyone is expecting them to still cut rates. And who gave them the pass? Perhaps the ISM services data that showed prices paid came in lower. There is a feeling that maybe we're not on this inflationary spiral that gives them the space to cut rates, but it highlights how constrained that central bank is in a way that maybe the Federal Reserve isn't.
Gilt yields lower, sterling a bit weaker, cable 124.27. Let's get you some news on our radar this morning. Treasury Secretary Scott Bessent saying the Trump administration is focused on bringing down 10-year bond yields, adding that the president is, quote, not calling for the Fed to lower rates.
So this is a change of tune for the president. I would say the president did say on Sunday to reporters that the Fed did the right thing, but how many times have we seen Trump 1.0 campaign trail coming into the White House? The president constantly saying he wants lower interest rates. He is a real estate guy, and he thinks he knows better than Jay Powell. So I'm just kind of wondering how long will this reversal in terms of where they are happy with where interest rates are is going to last.
At the same time, Tom Barkin, who was here yesterday, came in and he said, people think we control mortgages. People come up to me and they're saying, it's so expensive to buy a home. What are you going to do about it? And he said, we don't control that. We control the front end at best. So this is a real estate developer who is listening to people who understand that actually maybe the Fed doesn't hold the keys to the rate that he actually cares about. So, you know, maybe this will stick. We'll see.
I'm a real estate guy. They dropped rates and mortgage rates went up. But this is what Bessent's getting at, right? Secretary Bessent is making the argument that that reduction in interest rates contributed to those high yields at the long end, contributed to higher mortgage rates, which for people listening who might not be on Wall Street might sound really counterintuitive, but that's the argument that some people have made.
If you lower rates in the near term and people believe that there still is quite a bit of heat in the economy, then they ratchet up their expectations of long-term growth and inflation. This is the delicate balancing act that Scott Bessent, with a real estate developer as president, needs to manage. And it's the reason why maybe we saw the president come out and say he actually thinks the Fed did the right thing by holding, which surprised everybody.
How difficult is this going to be, though? Because, of course, tax cuts, higher tax cuts, and when Ed Mills was talking about what Scott Bessent said yesterday to Larry Kudlow, that he wants them to be permanent, how much more are you going to have to tap the debt market for that? And how much more is the bond market just going to push back on a higher U.S. deficit?
The 10-year Treasury yields right now higher by 2 basis points, 4.44. Let's turn to another story. U.S. allies expecting President Trump to present a plan to end Russia's war on Ukraine next week. Sources telling us here at Bloomberg the plan potentially includes freezing the conflict and providing Ukraine with security guarantees.
So I would say, and I was part of this reporting with the team, what I would say is this month is going to be pretty critical, and you can already see a major shift in tone. President Zelensky sitting down for an interview this week saying that he wants to end the, quote, hot stage of the war, and he is willing to speak to Putin. Now, after General Kellogg goes to the Munich Security Conference and unveils this plan to allies, he's also going to be, it's his first time as this envoy, going to Ukraine. At the same time, Zelensky himself is also going to be making a trip to the Gulf, definitely going to Qatar, definitely going to the United Arab Emirates. Diplomacy in the works at the moment because Trump is really forcing their hand to get to the negotiating table.
They are going after so many things simultaneously, it's almost jarring because it was so sleepy in the final few months, the final few years of the Biden administration. The contrast is just absolutely stark. How much they're getting done and how quickly it's happening, whether you like it or not, over the past few weeks.
Everything, everywhere, all at once. They're firing on all cylinders. And I've spoke to sources yesterday. I was at the White House. Everything they talked about and were preparing after Trump won the election, they wanted to come in and they wanted to make sure all of their people were in place, at least the initial top-level people, to get these things done. It is jarring because, not to be rude, but Biden was like watching paint dry. He himself would drag his feet for every decision, where Trump just comes out, and even if something is an idea floating around the West Wing, he says it out loud.
That's the latest on that front. Let's turn to the earnings. Ford warning that profit may fall by $2 billion or more this year, citing lower vehicle prices and expenses linked to the launch of new models. The company saying the forecast does not factor in potential tariffs from the Trump administration. That name is down by more than 6%. And Bramo, it could get a lot worse if we do see those kind of tariffs.
Well, Ford itself said that they could see billions and billions in profit destruction should some of these tariffs go into effect. You can feel this delicate dance that a lot of executives are doing. On one hand, they want to warn about the consequences of some of these tariffs, but they don't want to get in the bad graces of the president. So there is that sort of olive branch saying, we know that he doesn't want to destroy Detroit. We know he wants a strong, robust U.S. auto manufacturing sector. You can feel this tension as they realize just how much carnage could be done to their business and their profitability.
Ford is down this morning in the pre-market by more than 6%. Let's turn to more earnings. Let's turn to tech. Amazon reporting earnings after the closing bout today. Scott Devitt of Wedbush rating the stock outperform with a 280 price target, expecting another year of gains for the company. Scott joins us now for more. Scott, welcome to the program. We've heard from Google, we've heard from Microsoft. What do those two names tell you about what we could hear from Amazon later?
Well, I think the biggest overlap comes in the web services business, where Microsoft and Alphabet both underperformed. There's some idiosyncratic effects, particularly as it relates to Alphabet. The company didn't have capacity in the cloud business, which was the reason that it missed by 200 basis points. Microsoft was a little bit of a different story. So it'll be interesting to see whether Amazon, kind of takes control of the narrative again in web services in terms of being a share gainer, and that they're AI positive relative to kind of the positioning it's had the last 12 to 18 months of being, an AI market share donator to Azure. So that to me is the biggest data point, from those two. Otherwise, Alphabet and the advertising business was quite strong. I think that's a positive data point for Amazon's retail business as well.
At the same time, Scott, there's been a vibe shift in a pretty big way when it comes to capital expenditures tied to cloud computing and just how some of these companies are going to expand. We saw that Google was penalized pretty significantly by their $75 billion price point for how much they plan to spend. Do you think that Amazon can shift the narrative on capital expenditures at a time where really it's the fact that supply cannot keep up with demand?
Well, Meta, the stock responded positively to high levels of CapEx because the market's viewing Meta as being front-footed, and Alphabet, excuse me, I apologize, as being, on its back foot and having to spend to keep up in this transition, and so effectively diluting the margin profile. I think Amazon sits somewhere in between. I mean, there's a necessity to invest in the cloud business to retrofit it for selling AI services, but a lot of the Amazon spend as well goes to fulfillment centers and other things which are driving incremental high levels of growth. And so I think the market response, to the extent that Amazon doesn't shock with CapEx, but instead of, say, our $87 billion estimate, it comes in somewhere 90 to 95, that'll be digested quite well so long as the fundamentals are as strong as we think they are.
Scott, the focus has been so much on spending by some of these big tech guys. How much is the focus going to shift to cost cutting, to efficiencies? Andy Jassy has come out and talked about cutting middle management in particular and replacing with some of these machine learning tools potentially to reduce costs. How much are you looking for that type of announcement today?
So we had, 22 really the year of discipline across the board for all these companies coming out of the pandemic. And then, you've gone back into investment mode, but it's non-human capital investment. And I think you'll continue to hear that from companies, including Amazon, becoming more efficient with human capital and those gains being redeployed into capital infrastructure. And so I don't expect, meaningful leverage from Amazon in terms of that transition. But what I will say with Amazon is they're benefiting from a shift in their business in terms of where the advertising business and the web services business is so big now and growing so much faster than the retail business that they have a natural lift to their operating profits over time. And so Amazon, over the next 5 years, we expect that their operating profit's going to grow on a CAGR basis north of 20%, which is well north of both Meta and Alphabet.
Scott, Morgan Stanley says that Amazon's exposure to tariffs is higher than other e-commerce companies. What are you expecting on that front when it comes to the trade war we already see take place between China and the United States?
I try to take a wait and see with tariffs. I mean, if someone can explain to me what they're going to be and where they're going to be and everything else, then maybe we can put them in a model. But I think that Amazon is as well positioned, probably better positioned than anyone to deal with it. Certainly merchants that access inventory from places like China, could be affected. But I do think that, without having all the information, it's very hard to answer. But I do think that if it's a net negative for retail overall, then that's a negative for Amazon. But they're going to weather the storm better than almost any retailer, if not all.
Well, in this note, Morgan Stanley talked about that roughly 25% of the cost of products directly sold by Amazon come from China, and those items account for a little less than half of all products sold on Amazon. What's the wait and see? 10% was added to already the tariffs that existed on China.
You would either be digested by consumers, which is a possibility. We don't know what the outcome is going to be in terms of negotiations with China. And you also have the possibility of resourcing products from other locations. And I think nobody's more nimble than Amazon in terms of being able to help merchants do that. So like I said, I think it's a difficult question to answer at this point in time. And I would argue strongly that if you look at their peers in terms of the larger retailers, there's a lot of sourcing from China as well. And Amazon's very well positioned to defend against the change in terms of the cost structure of its merchants.
Hey, Scott, appreciate the input this morning. Thank you, sir. Scott David there of Wedbush, looking ahead to Amazon earnings after the closing bell. Three-part story there for many of you I know. The cloud business, what happens with ad spend, and ultimately what happens with e-commerce. On the cloud business, things were pretty mixed over at Google and Microsoft. Not impressive. That held back those two names, particularly for the likes of Alphabet. On the trade story for e-commerce, I think that's one to watch a little bit later. Is this helping them or hurting them, given what's happening to Temu and Shein?
That's a great question. How much are they able to redirect or capture a greater part of the business? We saw that Shein was being charged some 30% increases to ship into the U.S., and they were worried about logistical delays. because no one knows how to process some of these tariffs. So if there is this lack of knowledge, can you exploit that by jacking up prices? How do you take advantage of this at a time when you see Amazon increasingly taking on share?
Look out for that conversation after the closing bell when we get those Amazon earnings a little bit later on this afternoon. Equity futures on the S&P still just about positive, but fading slowly. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. President Donald Trump posting on Truth Social just minutes ago about his plans for the Gaza Strip. Trump writing the Gaza Strip would be turned over to the United States by Israel at the conclusion of fighting. The Palestinian people will be settled in safer and more beautiful communities. Trump adding no U.S. soldiers would be needed for the operation. Meanwhile, Honeywell shares are sliding 4.5% in the pre-market after announcing plans to split into 3 separate publicly traded companies. Honeywell has been under pressure from activist investor Elliott Investment Management, which called for the split to boost shareholder value. The breakup process is expected to be completed by the second half of 2026. And Nissan shares traded higher in Japan after the company announced plans to seek a new partner as it prepares to end talks with Honda. Sources telling Bloomberg the new ally would ideally be from the U.S. tech sector. Nissan's board is also pushing for a restructuring plan, according to sources, and the goal is to come up with a much deeper revamp by February 13th. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. I'm next on the program, counting down to payrolls.
It's very hard to know what's happening with growth and employment, what's happening with inflation, until you get a little more clarity on all of these uncertainties. If you look at the last SEP, there's a lean in there, toward cutting.
Joining us next, Jonathan Pingle of Natixis from New York City. This is Bloomberg.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones. Can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never. Go.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
live from New York City. If you're just tuning in, good morning to you all. Later on today, earnings from Amazon after the closing bell. Later on this morning, 8:30 Eastern Time, jobless claims. Equity futures on the S&P 500 just about unchanged following 2 days of gains. And the bond market yields are higher by a single basis point. The 10-year, 443. Under surveillance this morning, we're counting you down to payrolls.
It's very hard to know what's happening with growth and employment, what's happening with inflation, until you get a little more clarity on all of these uncertainties. I don't see any signs of an economy overheating. I think we've recalibrated to a place that is more sensible given where the economy sits right now. If you look at the last SEP, there's a lean in there, toward cutting.
A bias towards easing, a bias that he said wasn't kind of there, And there's no bias to hike either. What we got from Barkin yesterday, can we just pause for a second?
Yeah, sure.
That was a Fed official that just seemingly didn't want to say anything about the future at all across, a 6-7 minute interview.
Well, in fairness, how can they? Because right now, they don't have the clarity that anybody has, because nobody has clarity. Everyone comes on here and says, we have no clue. There was an interesting point that he made. What use is forward guidance at a time like this by the Federal Reserve? And is it still a tool if forward guidance is, we have no clue?
And a lot of people have no clue. And we've seen that from corporate America as well, from a couple of companies over the last few days who are just struggling to offer that guidance. And if they do, investors are struggling to believe it. We get some data later this week. We get payrolls. This is the outlook coming from Jonathan Pingle of Natixis, who writes, we estimate that non-farm payrolls rose by 240K in January, with private payrolls increasing 195,000. Jonathan joins us now for more. Jonathan, good to see you.
Good to see you as well, John.
Where does that number come from? Because 240 is pretty big, following a pretty big number in December.
Yeah, so I'll start with the fact that if you asked any economist what the hardest month to forecast payrolls is, they would say January, right? The post-holiday layoffs take around 2.8 million workers off payrolls, and then this is adjusted upwards by about 3 million workers to get that headline NFP print. That seasonal adjustment is, by definition, a huge source of error. And then on top of this is the month where you get the historical seasonals revised. So it's kind of like going into this with one eye blind. However, the last few Januaries, we've seen this very low layoff environment. And the low layoffs have really helped boost that January payrolls number.
You talked about the revisions and the sort of idea of how much they're going to change their 2024 jobs figures. I'm fascinated by that. How many jobs are we going to take off? Just how not good was last year, or how not amazing was last year, heading into this year at a time where some people were thinking that we were on the verge of overheating?
Yeah, it depends whether you're talking about payrolls or you're talking about the household survey estimates. If you're going to payrolls, it looks like the preliminary benchmark that we got back in August said that we were going to be down 818,000 jobs. I think looking at QCW data, it's a little bit closer to a 700,000 downward adjustment that we'll see tomorrow. However, you look at the household survey, it's being revised up by about 2.7 million for population, 1.8 for actual job growth. But they're meeting in the middle, right? We're starting to get a bit clearer picture of what was actually going on last year.
You have a really unique way of talking about the payrolls numbers, and I'll tell you why. You don't start off by saying economy good, number X or Y. You talk about it as if it's a random number generator, and this is what goes into it, and this is what I think it's going to spit out. When you say things like, I expected to say 240, I don't hear from you like, the economy was pretty decent, this happened, that happened. I just hear this is what goes into the random number generator. This is what I think the number will be. That's really unique, by the way. And you've been very accurate on that front. What do you actually think the economy is doing away from that 240?
I think the economy is doing very well in this post-election period, but is going to be coming and slowing down, right? The past two payrolls, and including this one, I guess, we're going to see a little bit of this, pre-election uncertainty unwind, right? December looked really good. And in some ways, as a business and as a firm, you didn't really know what was going to happen going into the election. You didn't know what industries were going to benefit, which industries were going to fail. And you really got a great sense of, or great clarity on, I can do hiring here, I can't do hiring here. And we think this really boosts these next couple months. But going forward, the actual Trump uncertainty, I think, will actually weigh on how much some of these gains can have going forward.
What are you looking for in particular to measure how much the Trump uncertainty is affecting a labor market? Is it having to do with just hiring plans more broadly, or is it having to do with, say, immigration and just simply supply of labor?
I mean, a lot of it's a growth effect. I think if you look at the sentiment changes that you got post-Trump and that really big sentiment boost, that really, I think, points to the really short term, right? And I forecast something that happened last month, right? Like payrolls is last month. This isn't a forward-looking indicator. However, it's the best shot we've gotten, the best picture we have at the moment. And as you go forward, you care a little bit more about, how does aggregate demand really interact with these things? How much does slowing immigration over the next few months going into Q2, how that affect the labor force there? How will demand externally and how will tariffs compete in certain ways and how we figure that out as well?
So if you're seeing a loosening of the labor market at the same time, we're going to see less immigration come through. Potentially it remains status quo. Is that possible?
Well, I'd also like to characterize this January print as not necessarily just a great print, right? The skew on the seasonals doesn't necessarily mean everything's dandy and it's going to keep going on very well. This is more that we've seen this skew in the seasonals in January for the past couple of years, and it's an assessment that hopefully will happen again this year. And then it's tempered by cold weather, which I had a bit less of an impact estimate than others, and the wildfires. But going forward, I do think that you'll see a payroll impact estimate from slowing immigration, but it'll be kind of harder to figure out how that happens to actual unemployment.
So do you think at some point this is going to be a window this year for the Fed to cut?
I mean, I think if you're looking at the economy in a broad way and looking at just payrolls in a broad way, we've seen almost 2/3 of the hiring in two sectors, healthcare, social assistance, and leisure hospitality. Is an economy that's hiring in only two sectors what they really mean by maximum employment? Is that what they really mean by that mandate? And I think that's worth questioning, especially as we get inflation kind of slowing into May. I think that becomes the question.
You think there's more weakness there than maybe meets the eye on the surface of things?
Yeah, I also think that the sectorization creates a little bit more of a brittle labor market rather than everything going well. And I think there's further room to cool, and I think we see that here.
This is what Citi's Andrew Honhorst has said as well, that the narrowness, the breadth, the lack of breadth when it comes to job gains is inconsistent with a healthy labor market.
The idea that quits and that hires are both just staying at very low levels in this stagnant level. The idea of sector-specific hiring doesn't give people flexibility if they get laid off in a sector that isn't exactly hiring.
That together with that low churn you describe.
Yeah.
That's problematic, let's put it that way. Jonathan, it's good to see you. Lots to talk about. Appreciate it, sir. That was a compliment, by the way. I enjoyed it. It's a unique take, a unique way of talking about the labour market numbers that we get.
And possibly more accurate at a time we're about to downgrade by almost 1 million jobs what we got last year. I mean, this to me highlights the lack of specificity that we really have to take.
Well, just to reiterate, Jonathan was the most accurate forecaster of payrolls through much of last year. Jonathan Pingle there of Natixis. The second, in case you missed it, was his dad. Up next on the programme, Jack Caffrey of JP Morgan Asset Management, Henrietta Trays of Vader Partners, Jeff Meacham of Citi, and we'll catch up with the Port of Los Angeles Executive Director Gene Soroka on global trade and what tariffs mean for his business. He had a monster 2024. That conversation is just around the corner. The second hour of Bloomberg Surveillance, up next.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. if you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
I think the U.S. economy is really strong, and it's really strong relative to the rest of the world.
We're still seeing strong trends when it comes to economic activity.
We've been seeing that the labor market have been holding up pretty well.
We still believe in the U.S. exceptionalism story on the growth fundamentals.
If you're a central banker in that situation, you're having to model growth down, inflation up.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures just about unchanged on the S&P 500. On the Nasdaq, a little bit softer. We're down by a bit more than 0.1%. Later on today, big focus on the Nasdaq when we get earnings from Amazon. So look out for that. Before we get there, at 8:30 Eastern Time, we get some numbers, some data, jobless claims just around the corner. Coming up this hour, we'll catch up with Jack Caffrey of JP Morgan Asset Management on the latest earnings. We'll speak to Henrietta Trays of Vader Partners as the Trump administration vows to extend tax cuts, and Gene Soroka, this is a must-watch one, up a little bit later, of the Port of Los Angeles on the risk for global trade. Before we get there, we need to talk about a Bank of England rate decision. They dropped rates by 25 basis points, Lisa, from 475 to 450.
And they did exactly as you expected, cutting growth forecasts and raising inflation forecasts. The breakdown was different than I thought. It was 7-2, not 8-1. You do get dissents from the Bank of England, and two people did dissent. Curious to see right now how they push this forward in terms of tariff uncertainty and how far they end up getting constrained by their bond market.
I can tell you sterling's weaker off the back of it, and we had some weakness going into it. Cable's down by 1 full percentage point. That is a weaker pound against the US dollar, 123.80. At the Bank of England, Bloomberg's Lizzie Burden has more. Lizzie, let's talk about this. The decision to drop interest rates 25 basis points, but the outlook, the change to the outlook, how problematic is that for a central banker?
It's a problem for central bankers, John, but let me just start with the vote split, because my jaw is on the floor here. Catherine Mann, the arch hawk formerly of the committee, voting for voting for a half-point cut, along with Swati Dhingra, who was already the archdove of the committee. If I'm seeing these headlines correctly, this is a real swing, and we were expecting an 8-1 vote split, but to have these two voting for a half-point cut here really just shows the worries about growth in the economy. And remember that the Bank of England is meant to be focused on inflation here, but you mentioned the forecasts. It's not a good look for the Chancellor Rachel Reeves when the UK government's top priority is meant to be economic growth. The Chancellor's just announced this raft of measures to boost the economy, and you know they're looking at a weaker outlook for growth. They're looking at inflation staying higher for longer, essentially. It's a picture of stagflation. It is not what Rachel Reeves would want to hear.
And Lizzie, we can see that the response in the gilt market actually might be a bit of a relief to the Bank of England. You're seeing 10-year gilt yields come in just a touch, so it isn't necessarily giving people the sense that you're going to have some sort of resurgence in inflation. Going forward, how much are you expecting to hear about whether the tariff backdrop is going to weigh on this, or whether this is just simply just because of the budget and the situation of stagnating employment and a real issue with growth?
Well, of course, the difficulty is they just don't know what's going to happen in terms of tariffs globally and specifically for the UK. For now, Keir Starmer is in Donald Trump's good books, but in any case, there will be an impact on the UK economy. Our economists at Bloomberg Economics say that if it's just avoiding direct tariffs on the UK, it'll hit growth. If you have direct tariffs on the UK, it'll also hit inflation, and that would put the BOE in a bind because it would be harder to rescue the economy. Andrew Bailey talks about how he loves free trade. I'm sure that that's what he will say in the press conference. But the difficulty is these forecasts may already be too rosy because they can't integrate policy that hasn't yet been set by Donald Trump.
Lizzie, I'd love to jump in and just get your thoughts on something. You know that I used to cover this central bank. I haven't lived there for 10 years. I'm not in the details like you are. But looking at this on the surface, this is a central bank with an inflation target of 2%. 2%. And they're forecasting inflation to drop below that to 1.9% in the first quarter of 2028. That's the first quarter of 2028, which raises an obvious question. Why are they doing this? Why are they cutting interest rates? Why are there some people on the committee voting to cut interest rates by 50 basis points? Why are they prioritizing growth over inflation? And do they just believe that if they don't protect growth, something bad's going to happen? Do they acknowledge that if they support growth, inflation will stay elevated? What's the thinking behind all of this? And how will they explain that in a news conference?
That is exactly what's going through my mind, John. And this is why I talk about what their mandate is. They're focused on inflation, supposedly, but look at the problems in the labour market. It's been deteriorating rapidly since Rachel Reeves's budget, and that is what they are showing in these forecasts, the worries about unemployment to come. Clearly, they feel like they need to help out with growth because the Chancellor's raft of measures on the supply side aren't set to take an effect for decades, perhaps, to come.
Lizzie, appreciate the update. Lizzie Burden there of Bloomberg. The Bank of England cutting interest rates by 25 basis points, a reduction of 25 basis points. But the vote split, to Lizzie's point, was interesting to see two individuals look to cut interest rates by 50 basis points at a time when they had to upgrade the outlook, lift the outlook for inflation. That's a difficult one to explain a little bit later.
And you highlighted that tension, especially because this is not a dual mandate central bank. I will just note, and I keep going back to it, that UK 10-year yields are lower on the heels of this. So no one is expecting this to cause some sort of resurgence in inflation. But there is a theory that it is harder to get back jobs that are lost as a result of interest rates too high than bring down inflation that gets a little bit hotter than, say, 2%, especially if it's not above 3% for a longer period of time. The currency is a little bit of the rub. And this is going to be a confusing picture to really
wonder
analyze.
if there's a message for the ECB in all of this as well. If they're doing this, if there are people on that committee signalling they would like to cut interest rates 50 basis points, your growth profile's not great either. Why aren't you doing the same thing?
Since when do German central bankers take advice from the Bank of England? But yes, I get your point. And there is this question about whether this is sort of a creeping dual mandate without saying it.
It's a healthy debate. Sterling right now is down by 1 full percentage point against the US dollar, 123.74. Let's bring it back to Wall Street with stocks looking to get a boost from earnings a little bit later, with Amazon reporting after the closing bell. Jack Caffrey of JP Morgan Asset Management writing this. Interesting times are more of a challenge for markets. There is extreme aversion to uncertainty, to the point that uncertainty can be paralyzing to many. Jack joins us now for more. Jack, good morning, sir.
Good morning.
Let's talk about that line. We're starting to see some of that from officials who just do not know what to do in this moment.
Well, you're left with having to respond. You're having to react to a series of executive orders. I think we're at 40 plus at this point in time, several of which have been ruled unenforceable by judges or multiple judges. And so it's rather hard to figure out how do you allocate. Now,
I think it's hard to sometimes allocate capital when I can change my mind quickly. It's a little bit more challenging if you're thinking about how do I allocate capital if I'm going to spend $50, $100 million on building a data center? Am I going to be able to rebuild in Southern California based on where environmental rules might be, where labor markets might be? And so I think we might rewind a bit to 2018, 2019, when you actually got a tax cut that was supposed to stimulate growth, and then you had a trade war, which led the companies question like where and how much I should actually be spending my money. And it's where companies want to spend their money that creates economic growth, that create job growth, that create the income, that ultimately pay the taxes that keeps this whole merry-go-round spinning.
Big tech has confidence to keep spending. They're spending in droves, and people aren't really liking it, even though they've got the conviction that the business will come and that really their biggest liability is just not spending enough. So why isn't it getting rewarded? You guys have certainty. Hallelujah.
I do think that there's a bit of a disconnect between what tech companies see and what they want to see. Certainly, if we go back to the late 1990s, I want to say it's Brian Arthur at Stanford came out with this idea that, you want to try to capture as much of the network as quickly as possible, and that you'll somehow achieve lock-in. And that, I think, leads to where you're hearing executives come back to this idea, if I build it, they will come. And a year ago, you were rewarded for if I build it, they will come. More recently, you're certainly seeing pushback from a couple of the big technology companies that have said, we will spend, and we're confident the demand will be there, trust us. It's that last line, I think, that has given some pause, and which has had some knock-on effects for all those other people who might be supplying, not just the building, but ultimately the GPUs, and then with DeepSeek a week and a half ago now, indicating maybe there are cheaper ways to achieve the same goals.
There's a lot of uncertainty right now on the policy front, and people seem to think that there's also a lot of uncertainty on the structural story around artificial intelligence, because that narrative has been flipping and flopping. Do you think that some of the sales of the nuts and bolts, the utilities, et cetera, around what we saw following DeepSeek, do you think that was overblown, or do you think that that is the beginning of a sort of right-sizing in people's expectations?
I actually think that we have to stage the challenge that we're experiencing, because what we hear and continue to hear is that actually getting the GPUs remains challenging, but that when you're actually looking to build out a data center, you have to build the whole building first. You have to build the HVAC system, you have to secure the electricity. That's a big chunky spend, and that actually then installing the racks of servers is much more incremental, and so that you can actually have some dialing down of the spending intensity if the demand isn't there. But ultimately, when you sit back and think, I need to come up with X 100,000 square feet of space, I need to have it attached to a grid that has power, and I have to commit to that over a several-year period of time, that's a much bigger check that you have to write up front before you actually get to see the demand unfold. And so, for all the excitement around, GPUs and the intensity of getting those GPUs, they actually, not to say they're a variable cost, but they're much easier to roll out in much more measured units rather than a building.
Right, but if all of that's going to be built in America, are those kind of the sectors you want to be exposed to?
Well, the buildings are built in America. The chip itself is built in Taiwan.
But
there's a whole different issue that we
definitely. But there's a lot of
go down the path.
But there's a lot of grants from the Chips and Science Act coming to the United States that we haven't even seen fully put into fruition in the U.S. to build those chips here.
Up until last Monday, when we basically said no more grant money.
But Donald Trump is talking about $600 billion of this Stargate AI. There is a lot of excitement around this space within the United States.
There's massive enthusiasm, and I do think that, that's why we had tech in such a strong position last year. But certainly, investors have been expressing some skepticism, and you can see that in the valuations. You can see that in how some of the stocks are trading, and where we've seen some rotation. Take me back to things that I have greater certainty on. Your guest right before I joined was talking about so much of our hiring has been in healthcare and in hospitality. The U.S. economy is 60% consumption, 65% consumption. That's a flywheel. Once it starts turning, it continues to turn. And I would say, as much as we live for Employment Friday, Jobs Friday, realistically, it's Unemployment Thursday that probably is the more telling issue with respect to, is that flywheel continuing to turn? And so long as we keep seeing these low 200,000 initial jobless claims, I think it speaks to the U.S. economy, a consumption-oriented economy, and actually not really Like, we're big traders on a dollar basis, but in terms of as a percentage of GDP, that's not really our cup of tea.
8:30 Eastern time for jobless claims. The estimate in our survey, 213, so in the low 200s. Jack, give me something to get my hands around. Give me a theme. Are you playing the rotation? Which sectors are you going to? What are you doing right now?
You know, I'm going to take some people at their word. I think, you know, healthcare has gotten very interesting. It's been absolutely hated for several years. It's lowest relative weight in the S&P, going back almost to Hillary care. For people who don't recall this gray hair as being earned and experienced. And I do think when you look through, you know, we have this demographic issue, which actually means the U.S. is creating lots of healthcare consumers over the next several years. There's definitely some bifurcation in valuations. If you touch GLP-1s, we still love you. If you have some questions around your pipeline, you are trading at 8 or 9 times earnings, which is to say no expectations of growth in the foreseeable future. But I think coming back to companies that are tied to more stable policies like Medicare, where you've continued to say we will continue to protect a social security net for the old, which is earned in some sense, I think winds up being an investable theme where you're not being asked to pay very demanding valuations. You wind up staying away from tariffs, you stay away from trade, all of your labor force is domestic. I think there's opportunities there. And financials, you know, while I can talk about government spending being somewhat paralyzed, corporate spending likely to be paralyzed over the next several months, the reality is the VIX continues to spike higher. You know, kind of interesting yesterday to see the TIPS ETF getting overbought, suggesting that some fixed income people are looking not just at yield levels, but, you know, what their compensation is within yields in terms of some risks out there. And so I think that fear, or that episodic fear, is good for trading activity and probably good for financials, who will also probably get a lighter regulatory touch for at least the next 2 years.
Most likely, that's for sure. It won't get any worse anyway. Jack, it's good to see you.
Thank you.
Great to catch up. Thank you, sir. Jack Caffrey there of JP Morgan Asset Management. Let's get you an update on stories elsewhere with your Bloomberg brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. Secretary of State Marco Rubio says he won't attend the G20 summit in Johannesburg this month. Among the reasons he cited was South Africa's attempts to promote equality, solidarity, and sustainability. The move adds strain to U.S.-South Africa relations, which have been tense due to South Africa's close ties with China and its refusal to condemn Russia's invasion of Ukraine. Meanwhile, Ford shares are falling 5.8% in the pre-market. The automaker warned its profit could fall by $2 billion or more this year. Ford blaming the weakness on falling vehicle prices and costly new model launches. And on top of that, CEO Jim Farley told Bloomberg that President Trump's threatened tariffs could cost the industry billions of dollars. And shares of Qualcomm are falling 4.3% in the pre-market. The world's biggest seller of smartphone processors expects the overall smartphone market to be flat or increase in the low single digits in 2025. Analysts did note that the results for the first quarter were otherwise positive. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, the Trump agenda.
If we do not get this tax bill done, and as I said in my Senate hearings, this is pass-fail for our side of the aisle, and we will have the largest tax hike in history.
That conversation up next with Henrietta Trays of Veda Partners. Live from New York City this morning. Good morning.
Influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Stock slightly positive by 0.05% on the S&P. Bond yields a little bit higher by 2 basis points, 443.62. Under surveillance this morning, the Trump agenda.
If we do not get this tax bill done, and as I said in my Senate hearings, this is pass-fail for our side of the aisle, and we will have the largest tax hike in history, and that will be on the people on our side who do not try to move this forward. In theory, tariffs would be a shrinking ice cube. Tariffs are a means to an end to reshore economic security in the U.S.
So here's the latest this morning. President Trump set to meet with GOP lawmakers later on today. The meeting coming after Senate Republicans broke with the House over the president's budget strategy. Henrietta Trays of Vader Partners writing, the budget resolution will contain hard and fast deficit authorizations. So the real test will be in the text of the budget resolution the committee marks up next week. Henrietta joins us right now for more. Henrietta, walk us through the process. Why is this process so important?
Yeah, the process is everything. All eyes should be on Lindsey Graham and the Senate Budget Committee. He is going to move forward with one small bill associated with military and immigration spending and energy component. And that's going to be the first bill that President Trump passes in the first half of 2025. It's going to take all year to write the tax bill. The tax bill also will have to go through the budget process. And that is the first step for any legislation that Republicans want to pass without Democratic votes this year. And it's going to be very hard fought and take the next 12 months.
Henrietta, I want to talk about tariffs as a revenue raiser that politically Republicans want to use to offset the tax cuts. Scott Bessent, Treasury Secretary to Larry Kudlow, is talking about the fact that this is a means to an end. But I caught up with Peter Navarro yesterday and Jason Smith of House Ways and Means, and both of them were talking about the External Revenue Service as a new place to be able to collect those tariffs to offset these tax cuts. Which one is it?
Yeah, you cannot have it both ways. You can't have a declining amount of tariff revenue and also a rising number of revenue components to pay for this tax bill. The tax bill is going to be a minimum of $5 trillion. If you're going to try to factor in $1 trillion in revenue from tariffs, you must implement the tariffs. And indeed, you have to have the tariffs escalate to accommodate the manufacturing supply chain shifts, consumer behavior shifts, obviously retaliation that we know is coming from other nations. So when it comes to lawmakers factoring in the tariffs, I think there's a really small basket of stuff that they can do via legislation that will officially score in their tax bill. The de minimis exemption, maybe even stripping China of its PNTR status, which is about a 40% prospect in my opinion. But those are the two pieces that can pass. For the rest of it, they're talking about $50 billion in bailouts for farmers because the trade war is going to be so aggressive. So, you really have to pick one. You can't have it both ways.
Right, and we saw the biggest bailout of Trump 1.0 go to the farmers, bigger than the auto industry because of the retaliatory effects of China. Something else Scott Bessent said in this interview, the goal is still for them to be made permanent, the tax cuts. Can the Republican Congress do that?
No, I don't think so. My odds of this being a temporary bill are quite high and rising that they will have to negotiate with Democrats at the end of the year. And it's now at 30% odds prospect. And here's why. When you talk about a $5 trillion bill, which is not even factoring in the wholesale no taxes on tips and no taxes on Social Security components that President Trump continues to tout, you do not have the votes for the magnitude of deficit reduction or offsets to cover that cost. The easiest way out of that quagmire is to truncate the duration of the bill. That's exactly why the tax cuts expire at the end of this year in the first place. In 2017, they only had $1.5 trillion in deficit authorization to work with, and that meant that the individual tax rates were going to expire. That's exactly what we're walking into this time around.
We've talked a lot, Henrietta, about what can get passed. And yet what we have seen from this Congress, the Republicans on both sides, is they're not willing, at least initially, to push back against Donald Trump's agenda in almost any way. Are we overestimating how much pushback there is going to be, and potentially are we underestimating how easy it is going to be to pass some sort of budget bill at a time where there does seem to be quite a bit of unity?
You know, I actually think that that is an incredible point. It's just that I reached the opposite conclusion. The reason all these confrontational nominees are sailing through is because of the legislative train wreck headed our way. And I think that what we're seeing in terms of them stepping aside for the OMB director, who is plainly supportive of challenging the Impoundment Act and other things that members of key committees don't like, is because it's about to get very rocky from here. When you hear Scott Bessent, the Treasury Secretary, say, I want to use current policy baseline, that's fine. You can say you want to use it, but it's not permitted under Senate legislation and Senate rules. And they're going to have to confront the hard reality of the Byrd Rule in a couple weeks' time, especially when we get to the tax bill. And so you can want it whichever way you're hoping for, and you can jawbone about current policy and say these tax cuts pay for themselves. This is a $3 trillion revenue raiser. But reality is going to hit you like a ton of bricks when you get in front of the parliamentarian of the United States Senate, and you have to find offsets or truncate the cost of the bill. And that negative reality that is going to be very immediate, as opposed to working through court cases, as we're seeing with DOJ and the other components, is going to be immediate. And I think that that's something that the lawmakers know, they're very aware of, and the Trump administration is about to find out.
Henrietta, we just have about a minute, but are you basically saying that some of these Republican Congress members are allowing some of the nominees to go through because they want to have the president's ear to adjust the budget negotiations as things get ugly?
Absolutely. I think it makes perfect sense. I mean, things are about to get incredibly rocky. You're seeing the intra-party divide between House Republicans and Senate Republicans right now. Whether it's Jason Smith in Ways and Means and Mike Crapo in Senate Finance, they have two competing agendas, mostly because Jason Smith is very concerned that he cannot get a tax bill through his chamber without the sweetener of border security and immigration spending and military spend. And Mike Crapo thinks that they can't get anything done for 12 months, and they want to use a current policy baseline, which means they don't have the votes in the House. So that intra-party war that has been around for 20 years, if not more, is about to come to the surface. We're just not seeing it because it's week 3 of the administration and they're acting on executive actions, not legislative. And that's going to change.
It is only week 3. Then we have to repeat that daily at the moment. Henrietta, thank you. Henrietta Trace of Veda Partners with the clinic on a process. The 10-year yield might want a word as well. The 10-year at the moment is down to 444. Down 40 basis points. BMO's Ian Lincoln reminds me, down 40 basis points from the highs of January.
A retracement of some of the inflation fears, but also a reigniting of some of the disinflation. I just want to say it's a beautiful thing, the 10-year. Let's focus on it.
The president's very focused on the 10-year yield.
I think he should be.
There you go. Up next, Jeff Meacham of Citi on the outlook for pharmaceuticals, with Robert Kennedy Jr. on track to become Health and Human Services Secretary.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Equity futures on the S&P positive here by close to 0.1%. Moving the other way on the Nasdaq 100, we're down by 0.1%. No drama so far this Thursday morning. Good morning to you all. We're 2 hours until the opening bell. Let's get you some morning movers. Let's say good morning to Manus Cranny. Morning, Manus.
John, and a very good morning to you. When it comes to a conglomerate like Honeywell, it's time to break up the gang. We knew this was possibly coming. Elliott, the activist investor, took a $5 billion stake in this company. That was revealed in the autumn. And they're getting what they want, which is split up to try and boost the valuation. You've got this stock trading on 21.5 times earnings per share for this year. And then you look at GE, trading at 38. So what do we get? Automation, aerospace, and materials. That's the trifecta. That's the breakup. Big part of the beast is, of course, automation, worth $18 billion. But then, of course, you get the actual numbers and the guidance, and they're missing on multiple fronts. They're missing in terms of the forward guidance on earnings per share, sales, and free cash flow. That's almost a validation of the narrative from Elliott. Either way, breaking up, it's never easy to do. Just take a look at GE and the valuation that subsequently came through there. Ford, again, guidance is everything. We're going to have price cuts on the cars. It's going to cost us more money to develop the new lineup, the Lincoln Navigator and the Ford Expedition. So profit's going to drop by about $2 billion. So they're going to make between 7 to 8.5. Originally, that was in the 10s. Originally, that was double digits. Tariffs, CEO Jim Farley was with Bloomberg yesterday. Billions and billions of dollars are the costs. That's the risk. And jobs here in the United States of America. He wants a reasoned discussion around tariffs and keeping some of those tax credits for producing in the USA. Right now, on the back foot. Qualcomm. You've had big tech, now it's all about the chips. And you think about it, this company, 75% of their revenue comes from handsets, from smartphones. Now, that business actually had a pretty hot additional quarter, 3 quarters in a row. It's been running quite hot. But it's about the slowing trajectory of that smartphone growth. That is what they see as being flat to increasing single digits. We talked about the lack of the upgrade cycle in the Apple story, but here's a qualification of some of the headwinds, perhaps to the consumer, and they exclude the renegotiation that they're doing with Huawei. So it's a feast really in terms of that whole smartphone discussion. Jonathan.
Manus, thank you, appreciate it. Manus on some stocks to watch and a little bit of relationship counselling along the way. And our radar this morning. Amazon set to report earnings after the closing bell. Investors focusing on the cloud business and online sales for the holiday shopping season. Cloud growth will be key after disappointments in the space from the likes of Alphabet and from Microsoft as well.
And they are really the big player with AWS capturing such a big part of the share. So how much are they seeing the same type of demand outstripping supply? I keep harping on this. I'm trying to make this story relevant. But I'm looking at what kind of efficiencies they're going to be talking about, because Andy Jassy put out a 1,400-word manifesto talking about cutting middle management with some of the efficiencies through machine learning. Do we see some of those layoffs to justify the payment for some of the capital expenditures? That, I think, is going to be an increasing theme.
I'm interested to know what's going on in trade. We talked about this earlier. Morgan Stanley saying that Amazon could be one of the biggest e-commerce giants hit when it comes to 10% tariff. But then you brought up a great point. This de minimis exemption means some of their biggest competitors from China, like Temu and Shein, they're the ones that are going to be hurt the most when it comes to making sure those tariffs are on products that are less than $800.
Net benefit or net negative? Does it help them or hurt them? Maybe they'll give us some commentary a little bit later. I want to turn to Google, but not about the earnings. Google is the latest tech company to drop diversity goals. In a note seen by Bloomberg, workers were told the company would no longer have aspirational goals tied to representation. Google going on to say it is committed to creating a workplace where all employees can succeed.
Some of these were put into place in 2020 following the Black Lives Matter protests. There, they looked to target a higher proportion of their staffs as being people of color, people of different ethnic backgrounds. This comes as they and others come under a lot of pressure from states like Oklahoma, who are suing them to try to say that they are not being constitutional. Expect to see more in this space, a really difficult dance, especially for tech companies that traditionally have been the bastion of some of these policies.
It also comes as Trump has basically made it clear within the federal government and also companies to what he calls root out illegal DEI. And Google is not just the first one to do this. We've seen this from a number of companies saying we are actually going to pull that back and focus on meritocracy and take all that language out.
It's the E where some controversy seems to be, the equity side of things. There seems to be a refocus, and of course they've got to navigate the legal issues as well, but there's certainly been a refocus in this country, in corporate America, to go back to the foundations of what this country was really all about. Equality of opportunity, not outcome. That's got to be the shift, and the shift that we're seeing from corporate America at the moment.
The way that a lot of diversity programs are put into place was through benchmarks, hitting certain benchmarks. It seems as if the shift, and this really started with affirmative action with respect to college admissions, has been retrenched in a pretty significant way by the Supreme Court. You're seeing that now trickle out into a lot of the outward policies of a lot of corporate America.
Let's turn elsewhere. On the government, this is a big focus too. More than 40,000 federal workers taking the Trump administration's offer to leave their positions with pay through September. An official at the Office of Personnel Management telling Bloomberg the number is expected to surge ahead of today's deadline.
I think for a lot of these federal workers, they also just want clarity to make sure that they will get paid for those months that were promised. And then potentially if they get more of that clarity, you could see the numbers go up. I will say $40,000 people sounds like a lot. Actually, it's below what their target is. So they do want to ramp that up before it ends because they want to be able to hit those targets. It's a huge part of the Trump administration's DOGE effort to make the government smaller and more efficient.
On April 30th is 100-day mark. I looked it up yesterday. I might be getting it wrong. It is April 30th, right?
I think so.
Okay, great. But what I want to do...
on the spot like that.
I didn't count the calendar days.
I count the calendar days.
We trust you.
Because I wanted to take a look at just how much has been changed at the federal government level, because we've heard all of this in terms of efficiency, in terms of cutting personnel, in terms of eliminating entire budget, entire departments. I want to understand how it shakes out, what gets challenged and what actually gets through.
The USA debate right now I find absolutely fascinating. It's disappointing to see Washington do what Washington always does, become tribal, not be open-minded that maybe both sides have got a point. We can have a conversation about soft power, the need for soft power, the influence we're seeing emerging from China. You talked about Latin America recently. We've talked about Africa for a long time, the amount of influence that China has there. We can have a good conversation about that. But at the same time, when Republicans demonstrate the amount of waste that's coming from there, some of the initiatives where taxpayer money has been going, you need to be able to sit there and be open-minded, park the tribal politics, and acknowledge that maybe that X, Y, and Z, what Caroline Levitt, the press secretary, has gone through, is not a good use of taxpayers' money. Maybe we can be open-minded about that. At the same time, perhaps we can have a conversation about the need for soft power. But at the moment, the politicians in Washington are just talking past each other. This idea they're going to fight against what? What are they fighting against?
The problem right now is that when nuance leaves the room, how much gets squandered at the same time, both on the waste side of things with programs that might not necessarily be necessary and that are wasting money, and on the need to be a counterweight to, say, China, in Peru, in Chile, in Argentina, going in there and making a real big presence to gain some footholds in some of the precious metals, et cetera. I think it's a really important point.
Which is something Secretary Rubio is trying to do, but in a very different way.
Yeah, what he's trying to do is, well, actually, he's going to basically take over USA and he's going to look by it. What they say is they're going to go line by line. I think there's also some Republicans, maybe not as loud, but there are some Republicans who say there's a ton of waste out there. We need to look into that. But there's others who also, maybe behind scenes, are saying there are projects we want to make sure we are protecting, especially those that are very hawkish when it comes to places like China.
Some amazing headlines on that front over the past few weeks, that's for sure. Let's turn to the healthcare industry. Robert F. Kennedy Jr. said to face a full Senate vote to become the Health Secretary after winning the endorsement of the Senate Finance Committee. Jeff Meacham of Citi writing the following: the executive orders over the past few days have shaken investors, and we acknowledge moving RFK Jr.'s nomination to the next step is likely to introduce further volatility. Jeff joins us now for more. Jeff, welcome to the program. Wanted to get into this with you. You know far more about this than we do. So just off the top, if he's confirmed, what kind of control does he have that would influence outcomes for some of the companies that you cover?
Yeah, good morning. It's a great question, and thanks for having me. Yeah, I would say in general, what we learned in the committee hearing for RFKJ was really, the reiteration of prior policies. I think what you say on podcasts, pre-election is maybe different on how you govern. So things like, vaccines, I think the policies there, may be a little bit more controversial, but I wouldn't expect, for example, the Inflation Reduction Act, the discounting mechanism for that, to be dramatically negative beyond current expectations. I think the stocks, and you saw pharma rally a little bit yesterday, just given the fact that, we may have hit a bottom here with respect to sentiment and risk of potential policy changes.
Jeff, we've been talking extensively about the dueling priorities of this administration. On one hand, deregulation. On the other hand, this idea of resetting expectations about what's allowed. This really is highlighted in the healthcare sector, where you have new drugs that are coming out, and potentially even faster because of different machine learning systems. With a government that wants to deregulate, do you think that RFK Jr. wants to lean into passing things quickly, or is probably going to hang up some of the new developments?
I think it's more likely to be the latter, just because you'll have new administrations, new leadership at CMS, at CDC, at HHS, including obviously RFKJ, and FDA. And so I think under this scenario, typically what you get, and this goes back to sort of historical trends, is a little bit of a right sizing, new middle management, new decisions. So, but I think your first point is exactly right. Even Trump knows that the U.S. biopharma industry by far is one of the most innovative in the U.S. And so no one really wants to stop or slow that down. But I think you'll see maybe a natural, kind of slowdown in the first, call it, 3 to 6 months. Beyond that, though, I think we'll be off to the races.
There also is an effort to really reduce costs, and this comes at a time where one of the biggest debates in your industry is whether Medicare and Medicaid are going to cover GLP-1 drugs and whether you're going to really enter into a negotiation. Do you see this administration as more amenable or less to that type of discussion?
I think it's probably more amenable to discounting through GLP-1s, but I think the main issue is that we know this going back to Novo's SELECT trial from a year or so ago, that it's not just the GLP-1 drugs are not just about weight